Hello all my dear students, I hope you all are doing good. So today we are going to start with one of the most important topic in your CA final exams. You can say this is one of the most important topic that is as important as PGBP, as important as transfer pricing or non-resident, is as important as TDS. So pay absolute attention on this topic please, all of you. And one of the reason why this is important that this has been asked in exam again and again. Almost every attempt ICI has been asking some or the other questions out of this topic. Even though it is not a very big topic, small topic of around 10-15 pages, that's it. Not a very big topic, but still it is extremely important. It's on the hit list of ICI in every attempt in fact. Second reason why this topic becomes important, because there are significant Finance Act 2022 amendments. Maximum in any chapter is going to be this chapter. If there has to be maximum amendment in any chapter in the entire income tax law, then it has to be this chapter. So there are significant amendments made by Finance Act 2022, which we are going to address over here. Okay. Significant. I am not saying there are one or two amendments. There are at every place there is an amendment. At every place. At every provision there is some or the other kind of amendment. Some are big, some are small. So you have to pay absolute attention over here please, all of you. Okay. Absolute attention. We will be doing the topic very precisely. We'll try to revise also. We'll try to do questions also to the extent it is possible. We'll try to do everything that we can do over here. Okay. So pay absolute attention please, all of you. Okay. Pay absolute attention. Taxation of trust. Now, when I say taxation of trust, what a trust is supposed to do? A trust is supposed to do some charitable activity or some religious activity, and that too it should be a lawful activity. A trust is not supposed to do an unlawful activity. A trust should do a lawful activity, a charitable activity or a religious activity. Then it can be called as what? As a trust. Okay. Now, the entire income tax law has divided all the trust into two categories. Two categories. Certain trusts are registered under certain sections and certain trusts are registered under certain sections. What are the two categories? That we have to see first of all. There are two regimes under trust. Two regimes. This is regime 1. This is regime 2. Regime 1 is for certain fund institutions, certain trust, educational or medical institutions which are referred in these sections, which are registered under these sections, who have got approval under 1023C, clause 4, clause 5, clause 6 and clause 6A. These are the four clauses in which regime 1 institutions and trust are registered. And what is regime 2? Regime 2 is charitable and religious trust which are registered under 12AA. Now under 12AB, 12AA is removed now by Finance Act 2021. Now 12AB. For us, what is important? Let me tell you, first of all, this background has to be understood by all of you. For us, this is more important. This is 5-star for us. This is 1-star for us. The regime 2 is the main chapter for us. The regime 1 is a supplement to us. Regime 1 is not most important. In exam, maximum questions are going to come on regime 2. In practical life, both are equally important. I am not saying in practical life one is important, other is not. I am not saying that. Ultimately, I am interested in exams, not in practical life as of now at least. So, sir, what is the difference between the two? Let me tell you the difference between the two. Regime 1 institutions, trust, associations are approved by central government. They are approved by whom? They are approved by central government. And regime 2 association institutions are not approved by central government. They have been given approval by the income tax authority. That is, the Commission of Income Tax will give them the registration certificate. And the maximum charitable trust which you see in the practical life are from regime 2 only, not from regime 1. They are not from regime 1. Regime 1 are very, very big institutions, big association like Mumbai University, like Institute of Chartered Accountant of India, all these people come under regime 1. They are approved by government. And in regime 2, all the big and small, all kind of charitable and religious trust will come in regime 2. Now, what Finance Act 2022 has done, let me tell you here itself. There has been lot of inconsistency between regime 1 provision and regime 2 provisions. Some deductions are allowed to regime 1, some are not allowed to regime 1. Some deductions which are allowed to regime 1, not allowed to regime 2. Some deductions which are allowed to regime 2, not allowed to regime 1. So the Finance Act 2022 has almost made both of them consistent. Something which was not available to regime 1 is not available to regime 2 also now. Something which is available to regime 2 is available to regime 1 also now. They have made consistency between the two regime provisions. So that has been more easy for us as a student, as a teacher. It is more easy for me. Why? Because now the provisions are consistent in both. It is not different. Earlier I have to say that in regime 1 this deduction will be allowed, in regime 2 this deduction will not be allowed, in regime 1 this disallowance will happen, in regime 2 this disallowance will not happen. So there was lot of inconsistency and lot of confusion among students. Now the government of India has made it consistent, very consistent, very consistent. Almost, I am not saying all, but almost most of the provisions of regime 1 and regime 2 are at par now. Most of them are at par now. Most of them. You don't have to worry about it, okay? Therefore, pay attention please all of you. First of all, put this thing in your mind that there are two regimes under the income tax law for various trusts and institutions. Regime 1, regime 2. Regime 1 covered under section 10, 23C, 4 clauses, clause 4, clause 5, clause 6, clause 6A. And regime 2 covered under 12AA, 12AB, 12AA is removed now. Now only 12AB. I'll tell you the history also of 12AA, etc. What exactly it is all about. Okay. Now, we are going to do the discussion from which angle, sir? We are going to do the discussion from this angle, not this angle. Not. Yes, whatever are the differences and the similarity, most of them are similar now. But our entire chapter, even Institute has not given anything on regime 1. They have given maximum discussion on regime 2 only. On regime 1 hardly there are 2-3 pages in Institute's material. But on regime 2, maximum discussion are from the perspective of regime 2 only. So what we are going to do in this chapter is, we are going to discuss the entire chapter mostly from regime 2 perspective. And then we'll compare with regime 1 also, how it is similar to that. Okay. So let's talk about regime 2 now. We are doing only charitable and religious trust, 12AA, 12AB. We are not doing 1023C, etc. We are not interested in all those things today. Yes, wherever it is going to come similar or different, difference though they have removed only mostly, most of the difference are removed. In case there are any differences, it is my duty to address you. It is very clearly written in the book. Therefore, the first thing which we need to address over here is, pay attention please all of you. If you are a trust, okay, then you need to be either a charitable or religious trust. It means your trust has to be charitable or religious purpose. Therefore, a question will arise. What question will arise? What do you mean by the term charitable purpose? What do you mean by the term religious purpose? Sir, what do you mean by that? Okay. Is the term charitable purpose and religious purpose defined under the income tax law? And let me tell you, the term charitable purpose is defined under the income tax law, but the term religious purpose is not defined under the income tax law. Sir, why so? Why they have not defined? Let me tell you. The term religious purpose they have not defined under the income tax law. The reason is, it is not possible to define the term religion in a country like India, where there are thousands of religions, different customs, traditions, communities. It is impossible to define the term religion in a country like ours. The government has said that understand the word religious purpose in common parlance. Common parlance means in common language. You have to understand the term religious purpose in your own language. Don't ask us. We are not interested in explaining the meaning of the term what? religious purpose. Yes, but the government has defined the term what? Charitable purpose. Where it is defined? It is defined in section 2 clause 15. It is defined here. So in section 2 clause 15, the government of India has defined the term what? Charitable purpose. How they have defined? They have defined the word charitable purpose in an inclusive manner. Inclusive manner, and this says that charitable purpose includes this. Sir, then what all things are included in the definition of charitable purpose? Let me tell you. First, charitable purpose. The definition is divided into two parts. Okay. There are 6 specific points in this definition, and there is one general point. Only one general point, and there are 6 specific points. Now, what is the difference between the two? Pay absolute attention. There are 6 points over here. 1, 2, 3, 4, 5, 6, which is specifically mentioning what is charitable purpose. And there is only one point over here which is not specifically mentioned, but it is a general point which will include lot of charitable activities. Let me tell you the specific point first. So what are the specific 6 points? I am telling you. Charitable purpose includes, first, relief of poor. If your trust is working for relief of poor, it can be called as a charitable purpose. Second, charitable purpose includes medical relief. If your trust is working for medical purpose, like hospitals, etc., it can be considered as a charitable purpose. Third, charitable purpose includes education. If your trust is a school or college, etc., then it can be called as a charitable purpose. So medical relief, education, relief of poor. Point number 4. Charitable purpose includes services in relation to yoga. If your trust is promoting yoga, teaching yoga to people to maintain their health, to improve their health, your trust will be called as a charitable purpose. Point number 5. Charitable purpose includes preservation of environment. If your trust is engaged in preservation of the environment, like save tree, save tiger, all these slogans have been raised by your trust, and you are working for that, and it can be called as what? As a charitable purpose. Last but not least, charitable purpose includes preservation of monuments. If you are planning, if your trust is preserving monuments, historical monuments of this country, then your trust can be called as what? As a charitable purpose. So charitable purpose has lot of points, 6 specific points. Again, I am repeating 6 of them. Relief of poor, medical relief, education, preservation of environment, preservation of monument, and services in relation to yoga. These are the 6 points which are mentioned under the income tax law. Now, what do you feel? There are only these 6 points which are good deeds in this world. There can't be any other good deed. Only these 6 things are good deeds in this world. There cannot be any other good deed. Yes, there can be. Definitely there can be some other good deeds as well. For example, I have a trust which is working for safety of women, women safety. That is also a charitable activity, but that is not mentioned in the 6 points. Suppose I have a trust which is working for promotion of sports. That is also a charitable activity, but that is not mentioned over here. So for that purpose, the government has given a general category, but that is coming with a condition. Government says that any other object of general public utility will also be charitable purpose. If, listen carefully now, if the commercial receipt is less than equal to 20% of total receipt. So what do you mean by commercial receipt? Commercial receipt means the fees which you are charging for that activity. Let me give you an example. Okay, let me help you with an example. Suppose I am engaged in what? Promotion of hockey. Hockey is our national sport and I am engaged in promotion of hockey. So I am taking what? I am taking some fees from the kids to teach them hockey. Say I am taking 1000 rupees per month. Okay. Like that, there were 1000 students. So in all, the fees which I collected was 10 lakh rupees. Okay. Apart from that, I also got donation. I also got donation of say 90 lakh rupees. So total comes to how much? 1 crore. Now, how much is my commercial receipt over here? This is my commercial receipt. Commercial receipt means the fees which you are charging. That's it. How much is my commercial receipt over here? My commercial receipt is 10% of my what? Of my total receipt. So if your commercial receipt is up to how much? Is up to 20% of total receipts, then you are also a charitable activity. Then you can also do charitable activity. You can also enjoy the benefits of the trust. But if it exceeds 20%, then you are not eligible to. So what about the first 6 points? For them, there is no limit. There is no limit for them. For them, there is no limit. There is no limit for them. There is absolutely no limit for them. For example, if a school is charging as much fees as he wants, there is no limit for them. There is no concept of 20% of the total receipt. There is no concept for them. The concept is only for the general category, which is coming in the 7th point. Suppose there is an hospital which is covered in the 6 specific points, right? So for hospital, there is no concept of what 20% of the total receipts. Hospital can collect more than 20%, also less than 20%. It is their choice. So the percentage criteria is only put for what? Only put for the 7th category, which will come under the any other object of what? General public utility. Okay. So for the first 6 points, which are specific points, there is no limit. There is no criteria of percentage. There is no criteria of 20% of commercial receipts. Nothing like that. For the 7th point, yes, it is, which will come in the general category. So this is the first thing which you can see over here. I have given an example also over here. You can read the thing from year till year if you want. Okay. I have mentioned over here the first 6 categories of purposes are specified categories who will enjoy exemption in respect of the commercial receipts from that activity in a previous year. For them, the concept of commercial receipt and all is not applicable. The concept of commercial receipt is applicable only for the 7th category, that is any other object of general public utility. I have given an example also over here. You can check. Okay. You just read it once if you want. Okay. Now let's move it. Pay attention, please. One of the most important source of money to the trust is what? One of the most important source of money to the trust is what? Donation. So let's talk about what is the treatment of donation under income tax law. Now, donation under income tax law can be of 2 types. First, where identity of donor is known. Second, where identity of donor is anonymous. Okay. So where the identity of the donor is known, the treatment is different, and where the identity of the donor is anonymous, the treatment is different. Anonymous donation means a person has given a donation but he has not disclosed his name. like you get the donation in the donation box. That is an anonymous donation, right? Because you cannot find out who has put the money inside the box. That is an anonymous donation, right? Now, in this also there are two types of donation where the identity is known. Identity is what? Known. There are two types of donation here also. One is called as, pay attention please, voluntary donation. Another is corpus donation. What do I mean by this? Voluntary donation and corpus donation. Voluntary donation means the donor has given a donation voluntarily to you and has told you you can use it for any purpose. Use for any purpose. You can use it for what? Any purpose. Okay. Now this donation is considered to be an income under the income tax law and it is taxable in the hands of the what? Charitable trust. What about the corpus donation? Corpus donation is given by the donor to you to use it for a specific purpose. Say for example, the donor has given you the donation and has told you, you have to use this for renovation of the building. Then you have to use it for the renovation of building only. You cannot use it for other purpose. So corpus donation means that you have to use it for a specific purpose only. You cannot use it for other purpose. And voluntary donation means the donation is given voluntarily. You can use it for any purpose if you want. So what is the treatment of corpus donation, sir? It is exempt but subject to some conditions which we will see after some time. Okay, in today's lecture only. The corpus donations are subject to exempt but subject to some conditions. They are not unconditionally exempt. They will be exempt subject to some conditions. Okay. What about anonymous donation? Anonymous donation are taxable under section 115 BBC at the rate of 30% plus surcharge and cess, whatever is applicable. So anonymous donation is very harshly taxable. They are not going to be getting any kind of relief from the income tax department. Okay. So the department is very, very harsh on them. So this is how the treatment of donation is done. Pay attention. You have to check in the exam which donation. Is it a voluntary donation? Make it taxable. Is it a corpus donation? Then you have to check some conditions which we will see after some time. Is it an anonymous donation? That also we'll see later. We have not done this. Okay. This is a separate section 115 BBC which will come at the end of this chapter. Not in today's lecture, maybe in tomorrow's lecture. Okay. Now pay attention please, all of you. Pay absolute attention, all of you. I'll just show you the treatment of this donation over here to all of you. Treatment of donation, and this treatment is applicable for both regime, that is for regime 1 also and regime 2 also. First, where the identity of the donor is known, then there are two possibilities, that there is a corpus donation and voluntary donation. Voluntary is taxable, add to income statement. Corpus is not an income, not taxable, but subject to some conditions. We will see that conditions after some time. Second, where the identity is not known. We don't know who is donating. It has come inside the donation box. I don't know how much donation who has done. So in that case, anonymous donation will be subject to tax under section 115 BBC. Okay. I hope it is clear to all of you. Is it clear? I hope it is. Okay. Now, let's go ahead with the discussion. Pay attention, please. How a trust will compute income. That is the most important part of this chapter. How a trust will compute income. Computation of income of a trust. So let me tell you first of all, trust has a very unique way of computing income, absolutely different from all the different kind of associates in this world. Absolutely different. Trust does not compute income in a normal way. It computes income in a very different way. Very different way. Let me tell you first of all, the provisions of trust are so different that for the trust associates, the concept of 5 heads of income itself is not applicable. For trust, what is not applicable? The concept of 5 heads of income itself is not applicable to a trust. The trust is outside the scope of 5 heads of income. Okay, 5 heads of income are not applicable to trust. No. salary, house property, PGBP, capital gains, IFOs, all those calculations are not applicable to trust. You're not supposed to make the income into 5 heads. You have to compute the trust income as per this statement which I'm going to show you now. Okay. So the first thing which will come always in the statement of a trust is income from property held. What do I mean by this? This will include all incomes. All. Every income will come over here only. Suppose let's take an example. This is in school. Let's take an example and understand from the perspective of a school. Let's understand that this is in school. Okay. So now, suppose this is in school. What is the income that a school can earn? Whatever income that school can earn, put everything here only. Everything has to be put here. Say for example, the school is earning a fees minus its operational expenses. Fees of 1 crore minus operational expenses of 80 lakhs. Therefore, the income from the property held of the school is 20 lakh rupees. Write down over here. Suppose if the school is earning some bank interest, then that also should be written here. No segregation of income. That PGBP separate, IFO is separate, HP separate, capital gain separate. Nothing has to be done like that for trust. For trust, all those possibilities are not there only. First, you have to keep this thing in your mind. Okay, beta? Second thing which will come over here, you have to put voluntary donation. Okay. Why not corpus donation? Because corpus donation is exempt. Yes, in some case it is taxable. Because exemption is subject to conditions. So if they violate the condition, then it is taxable. And if it is taxable, then put that also. But for that, we need to see the conditions first. We'll see that condition in a while. Don't worry. Okay. Say voluntary donation, 10 lakhs. And also corpus donation in some cases where they violate the conditions. By default, if nothing is mentioned, corpus donation is exempt. By default, corpus donation is exempt. Yes, if they are violating certain conditions, which we will learn later on, then it can be taxable. The total is 30 lakhs, for example. I am explaining with the help of examples, numbers. Okay. Now, so you have to do these two things first of all. Income from the trust. Then you have to write down voluntary donation if it is there in the question. Corpus donation by default exempt. Okay. Now, what has to be done after this? From here onwards, the trust will start to get lot of benefits now. Now I am making you count one benefits. Please pay attention. The first benefit. The first benefit that the trust will get 15% ad hoc exemption. Ad hoc means unconditional. Under which section? Under section 11.1. 15% flat exemption under section 11.1. So if I take 15% of this will be 4,50,000 rupees. So the moment you are registered as a charitable or religious trust, close your eyes and take this exemption always. Always you can take this exemption. Always. It is unconditionally available to every kind of charitable and religious trust under both the regimes. Under regime 1 also, under regime 2 also. Right now we are doing from chapter from regime 2 perspective. But under both the regime, you are getting the benefits over here. Okay, sir. Now also some amount is left, sir. How much is left? 25,50,000 is left, sir. What to do? Pay tax? Pay tax. Sir, I don't want to pay tax. Then what to do? I don't want to pay tax. Then what to do? Then there are ways to reduce tax. There are such ways to reduce tax that you can come to 0 rupees of tax. No need to pay any tax. Your intention has to be clear. If your intention is clear, you don't have to pay a single penny of tax. What am I supposed to do, sir? Please tell me. I'm writing here something. Do that. Make an application of your fund for charitable or religious purpose. Pay attention, please. I am explaining the meaning of this. Sir, what do I mean by this? Sir, what do I mean by application for charitable or religious purpose? What do I mean by this, sir? It's a very unique topic. You have to pay absolute attention, please, today. Very different kind of topic. That is the reason you have to pay absolute attention over here. You have how much fund? 25,50,000 will be subject to tax. No, sir, I don't want to pay any tax. And apply the money for the charitable or religious purpose. So what do you mean by the term apply? The word apply is very wide as compared to word expense. The government is not saying incur expense. The government is saying apply. So what do you mean by application? What all things can come in the application, sir? It's a very wide term. You can find out here some illustration over here. I'll just tell you one by one. This is just an illustrative list. You can apply the money for the charitable. Yours is in school, right? Yours is in school, right? It's a school, na? Yes, sir, it's a school. Apply for the objects of the school. Buy land for the purpose of students so that they can have a playground. So that will be considered as an application of funds. Yes, and you will get the deduction over there. You will get deduction over there. Don't worry. Okay. Great, sir. So what am I supposed to do exactly, sir? You have to apply the money for the objects of the trust. Like, I'll give you some examples which are mentioned over here. Repayment of loan taken to fulfill the objective of the trust amounts to application of income provided that expenditure incurred for which the loan was taken was not treated as an application. What do I mean by this? I have taken a loan of 1 crore rupees. Okay. And with the help of that 1 crore rupees loan, I have incurred certain expense. Don't take that expense as a deduction. So in that case, when you repay the loan, you will get the deduction. Again, I am repeating. I have taken a loan of 1 crore rupees. So with the help of that loan, I will do some expense, right? So when you incur the expense, don't take deduction. But when you repay the loan, you will get the deduction. Okay. Then, if you buy even capital assets, you will get deduction. Buy a machinery for the laboratory of the school. Buy a furniture for the laboratory or furniture for the school, benches for the school. You will get deduction over here in the form of what? Application of money. But then don't ask for depreciation, please. You will not get the deduction of depreciation in that case. We are really sorry for that. Don't ask for deduction of depreciation. Then, even if you pay income tax, that is also considered as an application of income over here. Have you ever heard about it? That income tax can also be allowed as a deduction, but here it is allowed. Even income tax will be considered as an application of income for you. That is a great benefit given by the government of India to the SSC. Great benefit. Even income tax they are allowing you as a deduction. Then if you are giving some loans to the children for further education, that is also allowed as an application of income. Can you see this? Can you see this? That is also allowed as an application. Therefore, the word application of income is very wide. It not only includes revenue application, it also includes capital application. You have to apply the money for the objects of the trust. You have to apply the money for charitable or religious purpose. We will give you great benefit over here. The examples which I have given you. If you take a loan for the objects of the trust and if you repay the loan, then that is also considered as an application of income. If you give loan to the students, educational loan to the student, that is also considered as an application of income. If you pay income tax, that is also considered as an application of income. Very wider as compared to your normal PGBP provisions. If you buy even a capital asset like plant, machinery, furniture, building, that is also allowed as an application of income. But then don't ask for depreciation. You will not get depreciation deduction under the income tax law then. Okay. Now there is one amendment made over here with respect to application. Very important amendment. The amendment was, the question is, because of which the amendment made, whether the application can be allowed on accrual basis or on actual payment basis. So the government has clarified in both the regimes that the application now will not be allowed on accrual basis. You have to pay actually, then only you will get the deduction. Otherwise, the application will not be allowed as deduction. Earlier, it was allowed even on accrual basis. So any sum payable by any trust shall be considered as application of income in the previous year in which Underline, the sum is actually paid by it irrespective of the previous year in which the liability to pay such sum was incurred. Where, however, during any previous year, any sum have been applied by such trust, and such sum shall not be allowed as application in any subsequent years. So therefore, here there is a very important amendment which they have made, that application means only on actual payment basis in both the regimes, in regime 1 also, in regime 2 also. Application means actual payment, not accrual. We will not allow you the deduction on accrual basis of application. On actual payment basis only we are going to allow you. Okay. So suppose, let's take the discussion ahead. Suppose this amount is 10 lakhs, for example. Okay. If I remove this, still there is a 15,15,000 rupees pending. So I made an application of 10 lakh rupees. I purchased land for school. I purchased plant machinery, furniture for laboratory. I paid income tax. I gave loan, etc., etc., etc. Whatever I could do for the objects of the trust, I did all of them. I did all of them. Now what to do? Now what to do? Now what to do? Now this statement is there in your book also. Don't worry. Step by step we'll go ahead. Check here. Check. Amount might be different over here. You can check the statement here. Okay. Now, you have to pay attention on this statement. Sir, I don't want to pay tax, sir. I don't want to pay tax on this 15 lakh rupees, sir. Please show me some way so that I don't have to pay tax. Please. Please show me some way, sir. I'll show you. Don't worry. There are a lot of ways in which you can save tax. Now I will show you 4 ways to save tax. 4, not 1. First of all, keep this statement in your mind. First of all, whatever is the income from property, you will write. Voluntary donation, corpus donation can also come. Again and again I am saying. Okay. Then less ad hoc exemption, flat 15%. And after that, whatever you have applied for charitable or religious purpose, you have to reduce that. And then 15,50,000. Suppose that is the amount left. Now how to save tax, sir? There are 4 ways to save tax. Let's see the 4 ways one by one. First, do you have a clear intention? The government is asking the assessee. Do you have a clear intention of helping people? Yes, we have a very clear intention of helping people. Do you have a clear intention that you would love to help people? You love to give people the aid, the necessary aid that you are supposed to give? Yes, we are 100% committed to that. That is what the trust is saying. Now, so the government is again requesting, then apply the money for the objects of the trust. So the trust is saying, we have applied the entire money, now we don't have anything left to be applied. Why we will unnecessarily apply? We have bought land, we have bought laboratory machinery, we have bought furniture, we have bought benches. Why again we will buy benches? We don't have space to keep the benches now. Why again we will do the same things again and again. The government is saying, it means you are 100% applied everything in your business, in your trust, right? Yes, we have applied everything 100% in our trust. So now the government is saying, if you don't have any option to be applying in your trust, then do one thing, give donation to another trust. Why don't you give donation to another trust? Why? If you have a clear intention, then either you should apply in your own trust to help people, or if you are not able to help in your trust, then give it to others. So the first option which the government is giving, the option 1, is what the government is telling the trust to give. What? Give donation to whom? To another trust. There are only 2 options. You have money, apply yourself. If you are not willing to apply yourself, give it to another person. Okay, so if they give this money to another person, then we will get the exemption. Yes. Sir, to whom should we give? The trust should also be registered under 12AB or 1023C on either of the regime. The trust can be registered in regime 1 or regime 2. It doesn't matter. You have to give to that trust. Who is registered under regime 1 or regime 2, it doesn't matter. First thing. This is the first thing you have to check. Second thing. The objects may not match. May not match. It doesn't matter that the object should match. Your object might be school, the other trust, the donee trust object might be college, or the donee trust object might be hospital. It doesn't matter. Both of them should be registered. Your object and the object of the donee may or may not match. It may match, it may not match. It's all fine. We are all okay with it. If it matches, then also we are okay. If it doesn't matches, then also we are okay. But the question is the other trust should also be registered. The third thing which you have to keep it in mind. We will allow you donation only if you give voluntary donation. Voluntary donation allowed. Corpus donation if you give, it is not allowed. Corpus donation is not allowed as deduction. So if you are willing to claim that as an exemption or deduction or application of income, you have to give that donation as what? As a voluntary donation and not as a corpus donation. To give as a voluntary donation. So you have to keep three things in mind. So what the government is saying, if you want to save tax, yes, we want to save tax. The government is saying you, will explain you how to save tax. First of all, try to apply the money at your end. If you are not willing to apply your money for your own trust, if you are not willing to apply, then give it to somebody else. They will apply, they will use that money at least for the welfare of the people. How should we give? Donation. And in that you have to keep three things in mind. First, the donee has to be a registered trust in either in regime 1 or regime 2. Second, the donee's object may not match with you, but it has to be registered. The donee might be hospital, you might be school. The donee might be any other object also, you might be school. That's all fine. Third, you will only get donation if you give the donation in the capacity of voluntary donation. If we give the donation in the capacity of corpus donation, we are not going to give you the deduction. Corpus donation will not be allowed as deduction. Okay. So this is how you are going to save tax. Okay. Where it is written? It is written over here. Various tax planning measures which are applicable for both the trust. Donation to another trust. This is the first point which I have mentioned over here. You can just read all the points which I have mentioned. You can find it over here. Check. Read. I hope you have read. Right? So, what is the second option, sir? Sir, tell us the second option to save tax. I'll show you. I'll show you one by one all the options. Just assume that this is financial year 20 to 23. Why assume? This is the financial year which is applicable for our exams. Okay. This is financial year 2020 to 23. Okay. Let's take this as a financial year. Now, the government is saying that if you want to save tax, then you have to apply this money for the objects of the trust. Now, I am saying that I am willing to apply this money for the objects of the trust. But I am not able to apply because this money is accrued to me but not received. So, till the time it is not received, how the hell I will apply this money for the objects of the trust? How the hell I will apply? So, till the time this money is what? Not received by me. How will I apply? How will I apply? Please tell me. So, this is my concern which is there in front of the government. That I am willing to apply this 15,50,000 rupees. But I am not able to apply because I have not received this money from the government. What shall I do? What shall I do now? So, let's see. Option 2. I'll explain you with the help of example everything and then only I will allow you to read. I will not allow you to read before that. Option 2. This is financial year 20 to 23. 15,50,000 is what? Accrued but not received. So now the government is giving you an option. Government is saying, yeah, take exemption today. Take the exemption. But make a promise. Make a promise that when you will receive, you will apply in that year. Make a promise. So in today in 22-23, government will allow me the deduction. Yes, they will allow you the deduction. On a hope that you will fulfill your promise. So today I am promising the government that please give me the deduction of this 15,50,000 rupees which is accrued in my hands but not received by me. Please allow me. Whenever I will receive, suppose if I receive in 24-25, listen, then the government says that there also government is very relaxing. The government is saying that apply here, or even if you apply 1 year after that, then also it is fine, or apply here. The government is giving you one extra time, one extra year to apply that money. Listen carefully now the provision I am saying. First I am explaining, then I am saying, then I am reading. I am not directly reading, you will not understand. It's a very, very tricky topic. 15,50,000 rupees. Is it accrued? Yes. Is it received? No. So the government is giving you exemption. But on a promise that whenever it will be received, you have to apply in that year or in the next year following to that year. That is also allowed. Sir, why, sir? Because sometime it may happen that suppose you have received the money, you have received this, suppose on the 31st March 2025, the last day of this year, then how will you apply in the same year? How will you apply? Is it possible to apply in the same year? The answer is no. That is the reason the government is giving you a grace of 1 year. So you can take the exemption in the current year and then you can apply in the subsequent year in which you will receive the money or the year following the year of receipt. Okay. Whichever year you will receive, you can apply in that year or you can apply in the next year also. Okay. And if you do not apply till year, then this 15,50,000 rupees will become your deemed income. Let me tell you very clearly. So you have to apply this till 25-26. Okay, otherwise it will become a deemed income in your hand because you are breaking your promise now. If you are breaking your promise, government will also reverse your deduction. They have given you the deduction here now without incurring the money. So now you have to incur the money till here. If you are not incurring, then it will become deemed income of 25-26. Be very clear about it. Okay, just check this example. Just check this provision over here. Point number 2. Is it clear? This is the second point. Okay. Second way of saving tax. So let's come to the third way of saving tax, which is the biggest out of all and the most important out of all. Biggest out of all and the most important out of all. Okay. Okay. Let's see this. Pay attention, please. Let me give you a complete example. Then I'll read also in front of you. Do you want to save tax on this 15,50,000 rupees? Yes, sir. I want to save tax on this 15,50,000 rupees. First option, apply for the objects of your own trust. Sir, I have done that. Then give donation to somebody else. Sir, I don't want to give donation. Then what is there in your mind? What is going on in your mind? Sir, what is going in my mind? Let me tell you. Sir, I am planning to start with a new project of a new building in the next 2-3 years. So this is financial year 22-23 going on. And sir, I am planning that I should start with a new project of starting secondary school or college in the next 3-4 years. Okay, so you are planning for expansion of the school? Yes. Sir, I am planning for the expansion of the school I want to make a secondary school, or I want to make a college in my premise. So for that I need lot of money, sir. And for that, if I need lot of money, I cannot incur this 15,50,000 rupees today. I want to accumulate this 15,50,000 rupees today so that I can use that money for the objects of my future plan. Okay. You want to accumulate this money. Yes, sir. I want to accumulate this 15,50,000 rupees today. The reason is because I will use it for certain specified purpose of the trust in future years, in next 3-4 years. Okay. So the government is giving you an exemption. Government is giving you an exemption of 15,50,000 rupees today itself. Take exemption, government says. Government says it is exempt under section 11 subsection 2. But subject to some conditions. Pay absolute attention. If you go and tell the government that I will not incur the money in the current year because I want to save the money for my larger purpose, the government will give you exemption today, subject to some condition. Condition number 1, you have to go to AO and give an application to him, and in the application you have to write the purpose for which you are what? You are accumulating, and the period for which you are accumulating, and the period has to be maximum 5 years. It cannot be more than 5 years. Okay, this is the first thing that you have to satisfy. Sir, what else am I supposed to fulfill as a condition? First of all, go to AO. Sir, we should go till which date? Till the due date. Go to AO till 139/1, due date of filing of return. You have to go to the AO till the due date of filing of return. Make an application to the assessing officer. Okay, sir, I have done. What I should write in the application? The purpose for which you are accumulating and the period for how many years you are accumulating that money. You have to write that also in the application. Okay, sir, I have done that also. Sir, what next? Let me tell you. Condition number 2. You have to invest the money. Invest 15.5 lakhs in specified modes under section 11(5), where there are generally government securities. You have to invest that mode in government securities. The government has given certain securities where you have to invest that money, like Kisan Vikas Patra, government banks FD, like Indra Vikas Patra, post office savings scheme, so on and so forth. You have to invest that money. You don't have to keep that money with yourself. You cannot keep that money with you. You cannot keep that money with you. You have to invest that money in the mode specified by the government. Okay. Then, sir, then what? Then obviously in future year you have to withdraw that money and you have to use it. Sir, then I have to use it till which date? I have to use it till which date? So listen carefully. This is the year for which you are claiming exemption. Yes. Ignore this year and count the next 5 years. Next 5 years means 23-24 is the first year. 24-25 is the second year. 25-26 is the third year. 26-27 is the fourth year. 27-28 is the fifth year. And 28-29 is the sixth year. Okay. Now listen carefully. Now there is an amendment over here. Okay. So what was the amendment? Listen carefully. So the amendment was, the provision earlier was that you have to withdraw this money from here and you have to use it till fifth year. Okay. And if you do not use it till fifth year, then it will become deemed income of the sixth year. Okay. So earlier what used to say, this is the first year. Listen carefully. Amendment 1, 2, 3, 4, 5. Earlier the government used to say that if you do not apply within the time, then it will become deemed income of the sixth year. But now the government has made an amendment and the government has said that no. The deemed income will not be of sixth year. The deemed income will be of the last year. And the last year is which year? Maximum 5 years are allowed to you of fifth year. This is a very minute amendment made by Finance Act 2022. Be very careful. Be very careful. I will also show you one question based on this amendment. That's prior to amendment what used to happen and after amendment what is happening. So prior to amendment what used to happen? Current year, ignore. After that, 5 years you have to accumulate and you have to apply in the 6th year. And then if you do not apply in the 6th year, then it is deemed income of the 6th year. But now the government has removed 6th year out of question and government has said now you have to apply the money in the 5th year itself. And if you do not apply in the 5th year, the deemed income will also be of the 5th year only. Be very careful, very minute amendment. I'll show you, I'll read also. I'll show you one question also based on that after some time. Okay. Sir, can I withdraw this money and give donation to someone in the 4th year? No. You are not supposed to give donation. You are supposed to withdraw the money and use it for the specified purpose only. You are not supposed to use it for any other purpose. Now you cannot give that as a donation to someone. If you do that, then it is a deemed income. If you do not apply within 5 years, then it is a deemed income of 5th year. If you withdraw in 2nd year and give donation, then it is deemed income of 2nd year only. If you withdraw in 2nd year from this government specified mode and invest somewhere else, then it is also deemed income of the 2nd year only. In short, you are supposed to withdraw the money and use it for the purpose which you have specified here in the application. You cannot use it for other purpose. What can be other purpose? You are withdrawing the money in between and using for some other purpose. Using for donating. Using for buying non-specified securities. In all the cases, it will be deemed income. And you will be liable to pay tax in that year itself. Yeah, if you are not using the money till 5th year, then it will become deemed income of 5th year. So if you are making a mistake, listen carefully. If you are making a mistake here, then deemed income will be here only. But if you are not using the money till year, then it will become deemed income of the 5th year. I hope it is clear to all of you. Is it clear? If you are not using the money till 5th year, then it will become what? Deemed income of the 5th year. But in the 2nd year itself, if you are giving donation to someone, deemed income in the 2nd year. 2nd year itself, you are using for some non-specified purpose, deemed income in the 2nd year only. 2nd year itself, you are using that money for what? For investing in some non-specified securities. You are removing the money from 11.5 government security and putting in some private security, deemed income in the 2nd year itself. And one big amendment is this entire concept was earlier there only in regime 2. So now this concept is also put in regime 1. As I have told you, they want to bring consistency in both the regime. This concept was not there only in regime 1. Now they have put it in regime 1 also. I'll read it once. After that, if you want to take the photograph of that, you can take that also if you want. Okay. If an assessee do not wish to apply the income in the current year, then it can take the benefits under 11.2 provided it wants to accumulate for specified purpose. For this purpose, a trust has to file a statement in prescribed form and manner with writing to AO specifying the purpose. You have to write the purpose in the statement. And the period. In no case, the period of accumulation should exceed 5 years. Maximum accumulation will be 5 years. The assessee is supposed to file the statement before the due date mentioned under 139(1). So as I have told you, everything is written in my board. The amount accumulated must be deposited in the mode specified in 11.5, mainly government security. Earlier it was only applicable for regime 2, but Finance Act 2022 it is applicable for regime 1 also. So now this is applicable for both the regimes because they want to bring consistency in the law. So what all things are written over here? You have to give if you want to accumulate, you can take the exemption today. You will get the exemption today, but you have to fulfill all the conditions. Go to AO, give an application. In the application, write the purpose, write the period, maximum 5 years, and you have to give the application till the due date of filing of return. Okay, and then you have to invest the money in the government securities. Okay. Now, if the amount is withdrawn and used for specified purpose, not used for specified purpose, then it will be deemed income of the year of withdrawal only. In the 2nd year, if you withdraw and use it for some other purpose, it will be deemed income of 2nd year only. If the amount is withdrawn and donated to another trust, year of withdrawal deemed income. You are not supposed to donate now. You are supposed to use it for the purpose which you have mentioned in the form. If the amount ceases to be invested in what? The government security, it will be deemed income of the year. You should keep it invested in what? In the government securities. Earlier, this provision was only there for regime 2, but now after Finance Act 2002, this provision is even there for what? Regime 1. And now the amendment which I said you, if such amount is not withdrawn and applied within 6 years, so earlier there was a concept of 6th year, now there is no concept of 6th year, the government has striked off this. I have striked off so that you come to know that this is an amendment. 11.3 has been amended to provide that any accumulated income which is not utilized for the purpose for which it is so accumulated shall be deemed to be the income of the previous year, being the last previous year of the period for which the income is accumulated. Which is the last previous year for which the income is accumulated? It is the 5th year, right? The 5th year is the last year of accumulation, right? Check. Just check it once. Now one last thing is over here. One last thing. Now that is not very important, but still I have to speak. Sir, whatever I write in that application that I will use this money for this purpose. Sir, I have to use it for that purpose only, sir? Yes, you have to use it for that purpose only. You cannot change the purpose in between. Sir, what if the circumstances are beyond my control? Then what? Sir, the building where I am making that particular thing, there is an earthquake there. And the entire building is collapsed in between. Then what will I do? And in that case, the AO will allow you to apply for other purpose. Check. But in India only. Not outside India. It will allow you to. But you should not give in that case also donation to another trust. You cannot give that money to the another trust. Donation is not all. You can use it for other purpose. So if you are not able to apply the money within 5 years because of some circumstances which is beyond your control, which is not in your control, then you can use it for some other purposes. You can go to assessing officer, convince him, he will allow you to use it for some other purposes for the objects of the trust. He will allow you to use it for the other purpose for the objects of the trust only, not for other purpose. Should be within the 4 corners of the trust, and you are not allowed to give it to some other trust the money in the form of donations and all. Okay. Now this provision was also earlier only there in regime 2, but now it is also there in regime 1. So they are bringing consistency across the provisions. So whatever was the inconsistency between the provisions, they are trying to bring consistency between the two. Okay. So there is an option whereby if the circumstances are beyond your control and if you are not able to use that money for the specified purpose, you can use it for other purpose in India only, not outside India. Okay. If you want to take a photograph of this, you can take a photograph of this if you want. Okay. It will help you. Don't worry. Okay. I hope it is clear to all of you. Okay. So this was the third way of saving tax. What was the first way of saving tax? Give donation. What was the second way of saving tax? I did not receive the money. That is the reason I am not able to apply. What is the third way of saving tax? The third way of saving tax is something which I have just shown you, a bigger one, a very important one, where you have to accumulate the money for a specified purpose. Okay. So now let's move on to the fourth one and the last one, which is the simplest one, whereby the government is doing what? The government is giving you, the fourth one is option 4. Option 4 is any other reason. So what do you mean by any other reason? Any other reason means the government is giving you, suppose this is financial year 22-23 and you have an income of 15,50,000 rupees on which you are supposed to pay tax. So government is giving a grace of 1 year. That's it. Grace of 1 year under section 11. Okay. 1 year grace means you will get exemption in the current year and then you have to apply this money in the next year. If you do not apply this money in the next year, it will be deemed income of the next year. It is as simple as that. Sir, wherever the deemed income is becoming, sir, in the next year, suppose it is becoming deemed income, sir, will we get again 15% exemption from it? No, you're not going to get again 15% exemption from it. The deemed income will not be subject to again 15% exemption in the next year. Okay, it will not be allowed. In whichever case we have seen, in case 2, case 3, case 4. Case 2 was one non-receipt of money. Case 3 was of accumulation of money. Case 4 is this one. Whichever case you are raising the money, okay. And if you are violating the provisions in the next year, you will not be liable for what? You will not be liable for what? Deemed income. and deemed income will not be liable for what? 15% exemption. So you have to add this and do not take 15% out of it, please. Do not take 50. You will not be eligible for 15% exemption on that amount. Okay. I hope it is clear to all of you. Okay. Now, this is the fourth case, which you have to keep it in your mind. Okay. Where it is written 1 year grace. Why, sir? Why, sir? Can you give me some reason why they are giving? Any other reason? Sir, any other reason will have some reason, no, sir? Yes, I'll tell you. For example, suppose if you receive this money on 31st March 2023, then how will you apply? How will you apply? Can you go to option 2 and say that I'm not applying because I have not received? You cannot say that because you have received that money in the same financial year on the last day. Suppose the income is of the current year and you receive on the 31st March of the same year itself, you cannot go for option 2 then. Then there has to be a grace of 1 year. Yeah. So this grace is given generally to almost all the trusts. 1 year extension is given by default. Okay. So this is the fourth option, and this is any other reason, as you can see over here. Check it fast, all of you, please. Okay. Just check it fast. A trust can make application under any other reason whereby it can claim exemption in current year without applying. In current year, you can apply. Without applying, you can take exemption. But in the immediate next year, the word immediate is very important. Immediate next year, you have to apply. Or else it will be deemed income of the next year. Okay. So I request you all to just go through whatever we have done so far. Read everything properly. And then only we'll go ahead with the next part. Please, all of you. Okay, so now there are 4 issues which I would like to address, which is related to this discussion only. The discussion is not independent. It is related to this discussion only. 4 issues which I will address one by one. The first issue is with respect to corpus donation. Now, sometime before I have told you the corpus donation is exempt. If you receive a corpus donation, is exempt, right? But that is subject to some conditions. So we need to understand what is that condition. I'll try to explain that. Slightly tricky it is. I'll make you write one example also on that. Okay. So what are the conditions subject to which your corpus donation will become what? Exempt in your hands. It will not be subject to tax. It will be exempt. So for that, you have to come to the book, page number 2. And these are the 4 issues which I am going to address. This is the first one, the second one, the third one, and this is the fourth one. Okay. Once these 4 issues are done, we will be done with the first part of this chapter. Okay. Then we'll move on to the second part of this chapter, which is certain registration, etc. How to apply for registration and all those things. Okay. Now, let's talk about the corpus donation first of all. How corpus donation provisions are written over here. When corpus donation is exempt, corpus donation shall not be included in the income of the trust or institution in respect of such corpus donation. A few restrictions have been imposed, which are given below. Okay. Exemption to such corpus donation will be available only if such corpus donations are invested in the mode specified in section 11.5 maintained specifically for such corpus. So let's try to understand this first line first with the help of an example. Example to understand. Corpus donation. Okay. Pay attention please. Suppose in financial year 22-23, a trust receives a corpus donation of rupees 100 lakhs. Okay. Now, if the trust wants the exemption, then it has to invest this donation in the modes specified under section 11.5, which is government securities. So this is the first thing that you have to keep it in your mind for corpus donation. Corpus donation is no more unconditionally exempt. If you want the exemption, you have to invest that. Where? To claim exemption, you have to do what? To claim exemption, you have to invest in the mode specified in section 11.5. Then only we will allow you the deduction of what? We will give you the exemption of corpus donation. This is the first point which it wants to say. Earlier, what used to happen? Once you receive the corpus donation, it is exempt. You can do anything with that. Now the government is saying, no, no, no. You have to invest that in the mode specified in 11.5. Okay. Now this is the first point which you have to keep it in your mind. The second one, pay attention please, is slightly tricky now. Second point. Application out of such corpus shall not be considered as an application. Now what do I mean by this line? Suppose in financial year 23-24, if a trust withdraws rupees 50 lakhs from the modes specified and apply for the trust, then it is not allowed as a deduction. This is what the government wants to say. That when you withdraw the money from where? From the corpus. First of all, what you have done? When you receive the corpus donation, what you have done? You have invested in the modes. Okay, that is exempt. Now, when you withdraw that money and when you apply that money, we will not allow you the application of that. Why? Because you are applying the money from exempt income. This 100 crore is anyways exempt now. So now if you are withdrawing the money from exempt income and investing that somewhere and putting that somewhere in the form of application of fund, we will not allow you that as deduction. It's very simple. Logic is what? Logic is very simple. Because you are applying from where? From exempt income. Yes or no? We will not allow you the reduction. So the rule is very simple. Step 1, when you receive the donation, you want exemption, invest in the mode specified. You will get the exemption and 100 crore is exempt. 100 lakh is exempt, whatever the amount is. Now, when you withdraw the money from that investment, you are withdrawing an exempt income. And when you apply that exempt income, you will not get the deduction. Okay? This is the second point. Now coming to the third one. Pay attention please. So this 50 lakhs, I will not get the deduction. No, you are not going to get the deduction of this 50 lakhs. It's not that easy to understand. You will not get any example anywhere. Institute has not given any example on this. They have just put the provision. The last part over here is this. Further, it has been provided that when it is invested in the mode specified in 11.5 maintained specifically for such corpus, from the income of the previous year, such amount shall be allowed as application in the previous year in which it is deposited back to the corpus to the extent it is deposited back. Now, what do I mean by this? There are 3 parts in this. This is the first part, this is the second part, and this is the third part of this section. Now, what does the third part has to say? Don't apply your mind much. Listen to me. Suppose in financial year 24-25, the trust has earned rupees 200 lakhs income. Now, out of this rupees 200 lakhs, rupees 50 lakhs is deposited back in modes under section 11.5 to maintain the corpus of 100 lakhs, then the trust will get deduction of rupees 50 lakhs on depositing back. Did you understand? No, nothing can be more simplified than this. The rule is very simple. When you get the corpus donation, invest, exempt. When you withdraw from there and then apply, do not ask for deduction. In the future, when you will again earn the income, put it back in the corpus, put it back in the mode specified from where you have withdrawn. Once you do that, to the extent you put it back, here I have put it back the entire amount, 50 lakhs. So I will get 50 lakh deduction. If I put it back only 30 lakh, then I'll get 30 lakh deduction. If I put it back only 10 lakh, then I'll get 10 lakh deduction. This is what this 3 paragraph has to say. Read the 3rd paragraph once again. Further, it is provided that when it is invested in the mode specified in 11.5, maintained specifically for such corpus from the income of the previous year, such amount shall be allowed as application in the previous year in which it is deposited back to the corpus, and to the extent it is deposited back. So we are depositing back to corpus. How much we have withdrawn? 50 lakhs. How much we are depositing back? 50 lakhs. So when you withdraw and you apply, don't get the deduction. When you deposit back, you will get the deduction. This is what this provision has to say. It's a beautiful provision. There can be a good question on this which can be asked. Institute does not have any question in the study material. You can take a photograph of this and you can write it down later on in your book. Take a photograph. I'll scroll down. Okay. Okay. This was issue number 1. There are 4 issues in all. This was the biggest one and the most trickiest one. Second, third, fourth is very, very simple. Nothing great as such. But I'll still explain you all of them with the help of examples. Don't worry. Issue number 2, which is self-explanatory. But still I'll explain you. Don't worry. Treatment of application out of loan or borrowing. Application from loan or borrowing shall not be considered as application. Okay. What do I mean by this? Second issue. Pay attention on the board. Point number 1. Suppose a trust borrows rupees 100 lakhs and applies rupees 100 lakhs for trust. Then no deduction. No deduction. But when trust will repay the loan, that time deduction will be allowed. Check. Check. Application from loan on borrowing shall not be considered as application when, however, such loan is repaid from the income of the previous year. Such repayment shall be allowed as application in the previous year in which it is repaid and to the extent it is repaid. So the rule is very simple. When you take a loan and you incur the expense, don't ask for deduction. Yes, but when you will repay the loan, at that time we will give you the deduction. Okay? Then just take a photograph of this. I am trying to clarify the things to the extent it is possible. I am trying to give you the examples for the simplest of the provisions also, so that on the day of exam, this tricky topic should not become a headache for you. Otherwise, it is a headache for you. Most of the students have a pain in understanding this topic, or else they do not understand in a proper manner and they feel that they know everything. It is not like that. You should be able to understand in depth this particular topic. Very, very, very much required. Third issue. Third issue is also important. Now, what is this third issue? Listen carefully. Third issue. Suppose this is financial year 21-22. And in this year, the income of the trust is 10 lakhs. Now, once the trust will get an income of 10 lakh, they will get exemption first of all. How much exemption? 15%. 15% will come to 1,50,000. Okay. Now, if you remove 1,50,000, this will become 8,50,000. Now, suppose the trust has applied 9 lakhs. Okay, so there will be what? A loss. Okay, there will be a loss. The question is, will this loss be allowed to be carried forward? And the department has said no, not allowed. This loss is not allowed to be carried forward and set off against the next year income. Okay, this is what the third issue is all about. Provide that no set off or deduction or allowance of any excess application of any year preceding the previous year shall be allowed. So are you doing an excess application? Yes, this is an excess application. This is an application which is the excess of your income. Because of which there is a loss, this loss will not be allowed to be carried forward and set off against the subsequent year's income. Check this please. Check this please. Not allowed. Not allowed at all. Okay. You can take a photograph of this. And the fourth and the last issue. Sir, will PGBP disallowance be applicable in trust? The answer is no. PGBP disallowance will not be applied in trust, but only two PGBP disallowance will be applied in trust. Only two. That is 40A3 and 3A, which is for cash payment in excess of 10,000. And second is 40A1A, whereby you make payment to resident to deduct TDS, and you do not deduct TDS, then 30% of the expenditure is disallowed. So the government has said that for trust, only these two PGBP disallowance will be applicable, nothing else will be applicable. And how will it be applied? It will be applied mutatis mutandis. So what do you mean by mutatis mutandis? Mutatis mutandis means it will be applied to the chapter of trust the way it is applied to the chapter of PGBP. In the same manner. The exact provision will be applied here in the same manner the way it is applied to the chapter of PGBP. Only these two disallowances. That's it. So what about 43B? 43B not applicable. So what about 48.2? 48.2 not applicable. So what about 48.5? 48.5 not applicable. What about 48.2? 48.2 not applicable. Only these two disallowances will be applicable to the chapter of PGBP also, which is applicable to PGBP will be applicable to trust also. Check. Only these two. Yeah, you can write here. No other disallowance can be attracted. You can write here, please. No other disallowances can be attracted. No other disallowances. Nothing can be attracted apart from these two disallowances. That's it. Okay. Okay. Now, there is one question on Finance Act 2022 amendment. I would like to show you all that question first. Then we'll go ahead with the next part. Okay. You all can come to your question bank. Chapter number 32, the very first question. So, I'll read the question. I'll do it with you all. Income of ex charitable trust for the previous year 21-22 is 80 lakhs. It is derived from the property held by trust and also from voluntary contribution by public without any direction. It means it is which donation? It is a voluntary donation. It is not a corpus donation, and voluntary donation is taxable. You need to have your calculators in front of you, please. During the previous year 21-22, the trust spends 4 lakh rupees. Okay. Is the application of the trust and sets apart 64 lakhs for the purpose of construction of school. Construction to be completed within 5 years, that is up to 31st March 2027. School construction expenditure out of the accumulated income is as follows: 55 lakhs in 2027 and 6 lakhs in 2027-28. Rupees 3 lakh is not utilized till 31st March 2028. The trust wants to know the consequence of the unutilized amount before amendment and after amendment. Now listen carefully. What I have said you earlier, that before amendment the situation was different, and after amendment the situation is different. Before amendment you can apply till 6th year and it would become deemed income of 6th year. But after amendment, you have to apply by 5th year, and if you do not apply by 5th year, it will become deemed income of the 5th year. So let's talk about before amendment situation first. Okay. Suppose year. Which year? This is the current year. Okay. So previous year 21-22 is the current year. So which will be the first year, second year, third year, fourth year, fifth year, and the 6th year. Before amendment, you can apply up to 6th year. Now, which will be the first year? I'll write all the years now. First year is 22-23. Second year is 23-24. Third year is 24-25. Fourth year is 25-26. Fifth year is 26-27. Sixth year is 27-28. Okay. Now, as per the old provision, they can apply till year. If they don't apply till year, it will become deemed income of this year. So how much they have applied till year? 55 lakhs they have applied. 6 lakhs also they have applied till year, till 2028. Okay. So only 3 lakhs they have not applied. So as per the old provision, 3 lakh will become deemed income of the 6th year, because till 6th year they have not applied only 3 lakhs. Now as per the new provision, you have to apply till year. If you do not apply till year, then it will become deemed income of this year. So as per the new provision, how much you have applied till year this year? You have applied only 55 lakhs till 5th year. Check. Only 55, because this is the 6th year now. If you apply in 6th year, then it will be deemed income. So as per the new amendment, 6 lakhs will become deemed income, plus 3 lakh obviously will become deemed income, because that is to apply in the 6th year. That is not applied only. So this amount will become deemed income as per the amendment, and this to obviously will become as before amendment also and after amendment also. Check. Is it clear? So before amendment, whatever is applied till 6th year, it is allowed. So how much is applied till 6th year? This much is applied. This is not applied. So 3 lakh will become deemed income of 6th year. After amendment, whatever is applied till 5th year has to be considered. How much is applied till 5th year? Only 55 lakhs. Because 6 lakhs is applied in the 6th year. That will not be counted. That 6 lakhs will be deemed income, plus 3 lakh which is not applied. Obviously, that will also be deemed income. So these 2 points will become deemed income. Check over here. Okay. I hope it is clear to all of you. Just go through the solution once. So now let's move on to some questions which are there in our textbook now. Okay, in our textbook which is there. Rest provisions are almost same in the textbook and in the compendium, in the color book. You don't have to worry much about it. That is the reason I have written here also. It is strictly recommended to do this chapter from compendium only, as the language of this chapter is difficult for the student to understand. A very technical language, but most of the things, everything, in fact in the color book it is more comprehensive, this chapter. Okay, now there are some questions which I would like to address you all. Which are those questions? The first one which I would like to address you all is, there are 3 questions over here. Now this is the first one. I request you all to come to page number 51.4. All of you will do this question together. Okay. The next questions I can give it to you. You can do it at your end, and then we'll discuss together. We'll do it in class itself. So for previous year 22-23 and previous year 23-24, XY Charitable Trust gives the following information. Okay. So we will only focus on the first year as of now, not on the second year. Now these are the incomes. Income from property held in trust, 7 lakh. Okay. Voluntary contribution with specific direction that the contribution shall not form part of the trust and invested in the specified modes. So again read what is given in the bracket. This 6 lakhs is coming with a specific direction. It means it is a corpus donation. Now when corpus donation is exempt, when it is invested in the specified mode. Are we investing in the specified mode? Yes. Therefore this amount will become exempt. Okay. because this is the corpus donation and you are investing in specified mode, so it is exempt. Then voluntary contribution without any direction. It means it is a voluntary donation which will be taxable under the income tax law. Okay, so what you are supposed to do, take your calculator, take 7 lakh first in your calculator because that will be income. Okay, then take 18 lakhs in your calculator, that will also be income. Total 25 lakhs is your income. Okay, now you will get flat 15% exemption, right? If you take 15% exemption, how much amount will be left? So after exemption, the amount will be 21 lakh 25,000 rupees. Did you get this answer? 7 plus 18 minus 15% will give you 21 lakh 25,000 rupees as your income. Now we will see what the application of income, where we have applied this money. Okay. So we have applied this money at two places. One is we have given some donation and second is we have applied for charitable purpose. Now let's talk about that. Donation to other public charitable trust 3 lakh. Yes, it is allowed as deduction, but there is some note given. Donation to of rupees 3 lakh includes cash donation of 80,000. Not allowed. 40A3 will be applicable. For trust, only two PGP disallowance is applicable. One is 40A3 and one is what? TDS disallowance. Therefore, you will be allowed out of this only how much? Only 2,20,000 will be allowed. So from 21,25,000. Okay. Remove 2 lakh. So now it has come to 19,25,000. Okay. But last thing is there over here. Income applied for charitable purpose 10 lakh. But there is also some point mentioned over here. Cash payment of 30,000. So this 30,000 will not be allowed. Because in excess of 10,000 not allowed. So out of this 10,000, 30,000 is not allowed. Consultancy fees of 2 lakh by an account pay check. Okay, that is fine. Account pay check is fine. To Z, a yoga instructor. On this consultancy fee, tax is not deducted at source during the financial year 22-23. So you have not deducted the tax. You have deducted and deposited the tax in the next year. Check. So what will happen? Out of this 2 lakh, 30% will be disallowed. 30% of 2 lakh comes to how much? 60,000. So this 30,000 will be disallowed first. Plus out of this 2 lakh, 30% will be disallowed. This 60,000 will be disallowed. So total 90k will not be allowed. So out of 10 lakh, 90k will not be allowed. It means how much will be allowed? It means 9 lakh 10,000 will be allowed, right? Out of 10 lakh, 90,000 is not allowed. Therefore, 9 lakh 10,000 will be allowed. Na? So from 19 lakh 25,000, remove 9 lakh 10,000. It comes to how much? 10 lakh 7 lakh plus 18 lakh. Okay. 21, 25. Then I'll just compute once again. There is some mistake in calculation I have done. 25. I have said everything correct. Huh? Don't worry. 21, 25. Then you will remove 2,20,000 as your donation. Okay. And then you will remove 9 lakh 10,000 as your. So it will come to 9 lakh 95. Okay. So this will come to 9 lakh 95,000. There is some mistake which I have done over here. This will come to 19 lakh 5,000. Sorry. Okay. This will be 19 lakh 5,000 minus 9 lakh 10,000. This comes to 9 lakh 95,000. Okay. So the first year I have explained you. Now it is your duty to teach me. You will teach me today. What has to be done in the second year? When you are doing for the second year, don't ignore this line which is given in the last. I want the answer for the second year, please. Please, all of you. I am giving you 5 minutes. So let's talk about the second year. In second year, what will happen? Take your calculators. First of all, 11 lakh will come. Okay. Then this will be exempt. Then 17 lakhs will come. Okay, 28 lakhs. Out of that, you will get 15% exemption. Okay. It comes to 28 lakhs. 15% exemption you have to take out of 28 lakhs. That comes to 23 lakh 80,000. Then you have to claim this as deduction, this as deduction. Okay. Total how much? 20 lakhs. Then you also have to claim this as deduction which you did not get yesterday in the last year. This 60,000. Because you have paid that TDS in the current year. So you can get the deduction now in the current year. So this comes to 3,20,000 rupees. I hope it is clear to everyone. Is it? I hope it is clear, yeah. It is a simple question. Now question number 2. It's a very simple question, nothing great as such. I am reading the question. You try to answer me. We'll do it together only. During the previous year 23-24, a charitable trust derived an income of how much? 6,70,600 from the property held under trust for charitable purpose. The trust actually spends 3,50,600 during the previous year. Determine the taxable income of the trust on the assumption. There are two parts. This is part 1. This is part 2. Now just read part 1 now. Don't read part 2. On the assumption that the trust has not applied for the option under clause 2 of explanation to section 11.1. To make an assumption that the trust has not applied for any option. Which option, sir? He had some options to save tax. That I will give donation. I have not received the money. That's the reason I am not applying. You had not that option. Assume that the trust is not applying for any of the option. Okay. Then what will be the income of the trust? Very simple. 6,70,600 will be the income. Out of that, they will get 15% exemption. Okay. So 670,600 multiply by 15% exemption. If you take, the answer comes to how much? 5,70,010 rupees. Out of that, you have applied how much? 3,50,600. So you have applied that much, and this much amount will be your taxable income. Okay. Okay, this is your taxable income. Sir, what is the tax rate of a trust? Now that depends upon. A trust can be registered as any person. If a trust is registered as a company, then the tax rate for the trust will be company, like section 8 companies. If the trust is registered as a firm, then it will be chargeable at firm rates. If the trust is registered as an AOPBOI, then it is chargeable at AOPBOI. That I cannot say. If a trust is registered as a cooperative society, then it will be chargeable as a cooperative society. That I cannot say. Now what is part B? The trust has applied for the option and has opted for applying the unutilized portion of the income for the charitable purpose during the next previous year, that is 24-25, and has actually spent 67,800 during that previous year. Now please tell me, which is this option? Where you go for an option where you take 1 year grace period. Which is this option? This is the last option, last one. So in the last option, what happens? You will get exemption of 2,19,410 today. But in the immediately next year, you have to apply. But what happened over here in this question? In the next year, you only applied 67,800. Therefore, in the next year, if you only apply 67,800, therefore the differential amount will be taxable in the next year as deemed income. Yes or no? In the last option, any other case, fourth option, you get a grace of 1 year. This is what this particular point is trying to tell you. This point is trying to give you a grace of 1 year. You can get a grace of 1 year. You can claim exemption in the current year, but you have to apply in the immediately next year. And if you do not apply in the immediately next year, then the differential amount will become deemed income of the next year. And how much is the differential amount? You are supposed to apply 2,19,000, but you applied only 67,800. Therefore, 151,610 will become your deemed income of the next year. Just check the solution, all of you. Okay. Now the mode which I was saying again and again, there are modes of investment. I have written over here as a disclaimer. Do not try to remember. Specified modes. These are the specified modes. You can just check it here. Investment in government security, post office saving bank, deposit with scheduled bank or cooperative bank, investment in UTI, investment in central or state, all of them, most of them are government securities only. Most of them are government securities. Okay. So this is just for your reference. You are not supposed to remember all these things, please. Now this is one last question over here. Just go through this question and get me the answer. I am not going to do this question for you all. You are going to do it, and then we'll go ahead with the next part of this chapter. Okay. Now, let's discuss this question. During the accounting period 31st March 2024, income from the property held for charitable purpose 4,40,000, 2,15,000 received in cash and remaining balance of 2,15,000, 25,000 to be received in 25-26. So take in your calculator 4,40,000. This is your income. Now voluntary donation 7,05,000, out of which 4 lakh is with specific direction that it shall form part of the corpus of the trust and invested in the specified modes. So this 4 lakh will become exempt because you are investing in the specified mode and it is a corpus donation. So this comes to how much? 3,05,000. Okay. Because 7,05,000 minus 4 lakh will come to 3,05,000. So this is 4.4 lakhs which is going to be added to the income statement, and this 3.5 lakhs, 3.05 lakhs which will be added to the income statement. Okay. Now you can take 15% exemption in that and you can let me know how much it comes to. It comes to 633,250. Now after that you have to apply 70,000. So you will take 70,000 as an application. Okay. Now you have made a promise to the government that this 2,25,000 will be received in 25-26, and you have claimed exemption in the current year. So you have to fulfill your promise. So if it is received, it will be received in 25-26. Then you have to apply in 25-26 or 26-27. So how much you have applied in these 2 years taking together, 25-26 and 26-27, you have applied only 50,000, and therefore the differential amount will become your deemed income. Okay. So out of 2,25,000 promise which you have made, you have only applied how much? You have to apply by which year? In the year of receipt or year following the receipt also you can apply. So you can apply in the year of receipt or year following the receipt. So you have applied only 50,000, and therefore 1,75,000 will be deemed income of 2027 over here. Okay. I hope it is clear to all of you. Okay. Just go through the solution once. So whatever options we have done now, these are all questions based on that option. So I've tried to put questions on every option that is possible. We have done one question on what? One question on accumulation, which we have done in the amendment part. One question here, one question on fourth option. We have done questions on everything that is possible. One question on disallowance of 40A3, disallowance of 40 small a. We have tried to do questions on everything. Okay, just go through it and then we'll move ahead with the next part. Okay. So now let's move ahead with one last provision for this lecture, and then we'll continue the discussion in the next lecture. And one last provision for the day is section 11.7. Now what is this section all about? Let me tell you, it's a very small section, very simple section, not very important for exam, but still we have to do it obviously. Section 11 subsection 7 says that once you are registered as a trust, then you cannot enjoy the exemptions, the general exemptions under section 10, not allowed. So if you are registered as a trust under section 12AA or 12AB, then you cannot enjoy the general exemptions which are given under section 10 except 3 people. Only 3 people have been allowed to do that. Who are those 3 people? One is 10.1, one is 1023C, and one is 1046. I'll just give you a brief background about these things. Okay, pay attention please. I just made an example over here in the form of a chart. Once a trust is registered under 12AB, then it cannot enjoy general exemptions under section 10. Why? What is the reason? The reason is very simple. Because you as a trust, you are enjoying great exemptions. And because you are enjoying great exemptions of section 11 and 12, we will not allow you the general exemptions which are available to general assessees. Does the general assessee gets your exemptions? Does a general person will get the 15% ad hoc exemption? Does the general person is going to get the exemption of accumulation, the exemption of giving donation, the exemption of payment of taxes, the deduction of application? No, they are not going to get all those things. So in the same manner, the government has said that we are not going to give this particular benefit to whom? This general exemption of section 10 will not be allowed to trust assessee. Okay, but in that also they have created exception whereby they have allowed 3 exemptions to them. One is 10.1, 1023C and 1046. Now what are these 3 exemptions? 10.1, everybody is aware of that. 10.1 is agricultural income. You will get agriculture income. Okay. You can get the exemption of agriculture income, no harm in that. Then what is 1023C? 1023C is regime 1 provisions. Can continue with the regime 1 benefits. Then 1046. What is 1046? 1046 is certain central government and state government institutions get some tax benefits over there. Only to the government institutes. Government institutions are there. So only these 3 benefits are there for a trust. If somebody asks you which exemptions out of 10 are available to trust, say only these 3. Only these 3 exemptions will be available to trust out of all the exemptions which are there under the income tax law. Now, in that also, listen carefully, please. Now, there are some exceptions over here. The government has created some provisos for these 2. This is unconditionally exempt to trust, but this is not unconditionally exempt. The government has made some proviso over here. Let me read that proviso one by one. On page number 54.5, provided that such registration, it means 12AA or 12AB registration, shall become inoperative from the date on which the trust is approved under 1023C or notified under 1046. What do I mean by this? It means if the trust is notified under this sections, then you cannot get the deduction, then you cannot get the benefit of 12AA and 12AB. It means you have to take a decision. You have to choose one of them. You cannot take both of them. For example, what does first proviso to section 11.7 says? It says the following things. Suppose you are registered under 12AB. Right now you are registered under 12AB. Now you get approval under 1023C. The moment you get approval under 1023C or 1046, your registration under 12AB will become ineffective now. It means you have to choose one of them. You cannot take both of them. You cannot take both of them. It is not allowed. This is what the first proviso has to say. Similarly, the second proviso says that if you want to come back to what 12AB, now you are leaving 12AB and going to 1023C and 1046 now. Now if you want to come back to 12AB, then you have to withdraw. You have to give up what 1023C and 1046. Check. Provided further, where the registration has become inoperative under the first proviso. Earlier it was inoperative, right? You may apply to get registration operative under 12AB subject to the condition that the approval under 1023C and 1046 as the case may be to trust or institution shall cease to have effect. So you have to give up on these 2 if you want the benefit of this. Moral of the story is very simple. A trust can enjoy. Write down this. Either 12AA or 12AB or 1023C and 1046, but not both. You cannot enjoy both. You are not allowed to enjoy both. What this section, small section, wants to tell you, it's a very simple thing, that if you are an assessee who is registered under 12AB, then you cannot get the exemptions under section 10 except 3. 10.1, yes. 1023C, yes. 1046, yes. But then they created a proviso for 1023 and 1046, not for 10.1. 10.1 is unconditionally exempt. And then they say that you have to choose between the 2. If you take 1023C or 1046, registration under 12AA, 12AB will become ineffective. And if you want 12A, 12AA, 12AB, then your 1023C, 1046 notification has to be withdrawn. You cannot take both of them. Okay. So today let's continue the discussion with the taxation of trust. Today we are going to do some procedural provisions. Provisions which are absolutely procedural in nature. Okay. So pay absolute attention, all of you. Today we are going to understand the provisions of how a assessee makes an application for registration of trust, under which section the assessee gets registration, who gives the registration, what is the time limit for registration, so on and so forth. Okay. Now there has been a great amount of change the procedure of registration very recently. Great amount of change. Great means great. I'll tell you the old provision also. I'll tell you the new provision also. I'll tell you the distinction also. Pay attention, please, all of you. Old provision. In the old provision, assessee used to make application under section 12A. In the new provision, which was certainly applicable from 1/4/2020, but then it got extended to 2022. Okay, exact date I'll let you know. Because of the COVID, they were extending again and again. In the new provision, the assessee will make application under section 12A only. So this is something which is similar. Okay, once you make the application, the registration will be available under 12AA in the old provision. But in the new provision, 12AA is scrapped now. The registration now will be available under 12AB. Okay. So there is only a difference in section, sir? No. Just a second. There is only a difference in section? No, absolutely no. There are drastic differences. Let me just name few of them. In the old provision, what used to happen? In the old provision, once the CIT has given you registration, that registration is applicable for lifetime. But in the new provision, now once the CIT will give you registration, that registration will be applicable for maximum 5 years. After 5 years, you have to reapply. So in every 5 years now, the trust has to reapply for application for registration. This is one major difference. Second difference, in the old provision, once you make an application, to get the final registration directly. But in the new provision, if a new trust goes and makes an application, they will first get a provisional registration for 3 years. Once government will provisionally give them registration for 3 years, government will observe their activities, and after the government has observed their activities, after that, the government will do what? The government will allow them what? Allow them the final registration. So now, the things have changed drastically. A lifetime registration is gone, maximum 5 years. A new trust will not get registration directly. First, they have to prove provisionally 3 years they are correct. They are doing genuine activities. Once they prove that, then the government will give them what? The final registration. Okay. Now, all these things, further, the big thing which I have not said so far is all those who were already registered under 12AA. There are thousands of trusts who are already registered under 12AA, right? All of them have to re-register under 12AB. All of them, all existing trusts also have to reapply for their registration. That is a very big task. All of them have to switch to the new registration procedure. And now, one very small difference. Earlier, the registration application also, all of them have to be manually. Now everything is online. Earlier, people used to physically go and submit the application, etc., and prescribe form. Now you don't have to do all those things. Now you have to go and directly submit online. The biggest change over here is 5 years. For new trust, only 3 years provisional, and then they will check and give final registration. Then there are a lot of small things over here. I'll be explaining all of them with the help of examples, don't worry. And there are a lot of blunders also made by the government of India in the provision. I'll tell you the blunders also. When the government made this provision, there are some mistakes in that. I am not saying that it is a mistake. Not only I am saying that it is a mistake. Even Taxman is saying it is a mistake. Taxman, which is a very great publisher for direct tax and indirect taxes, they are also saying that there are some mistakes. I also agree to that there are some mistakes in the provisions which the government have made. I'll be explaining the mistakes also. Institute doesn't know all those things. Institute has not mentioned all those things. Obviously, Institute cannot criticize the government of India in their study material. But we have full right to criticize if it is wrong. Okay. So, without wasting any further time, shall we start with the discussion of the new registration regime? Let's start. Come to page number 54.6, all of you. Here there is a box. Try to understand the importance of every box first of all. This is different types of entities. Okay. This is the time limit for uploading application. It means the time to give an application. By when you should give an application. Is the time for grant of registration. It means once you give the application, how much time department will take to give the registration. This is from which year exemption will be available to you. From which year once the registration is approved, from which financial year or what, from which assessment year you will get the exemption. And this is the exemption will be available. The registration will be available for how many years? As I have said you, it will be maximum for 5 years, not more than that. Okay. So this is the category. First column is the category of trust. Let's talk about the first category. Existing trust which are registered under 12A or 12AA on or before 31st March 2021. So if your existing trust, listen carefully. This is case 1. Let's write here. Okay. Case 1. Or else just wait. So I've already made the issues over here. I'll show you how to address the things. Okay. So I'll read the first case from here itself first of all, and then I'll explain you with the help of an example which I've already made for you all. Don't worry. If I'm an existing trust which is already registered under section 12A or 12AA on or before 31st March 2021, then I'm supposed to make an application till which date? Till 30th June 2021. So all those who are already registered before 2021, there might be thousands and lakhs of trusts. All of them have to come to the government of India and they have to make an application till this date. But again, if you remember, during this date means what? During the month of April, May, June 2021, there was a dangerous COVID which was spread across the country. Do you remember that? You remember that or not? Dangerous COVID was there across country. The government has further extended this date till which date? I have put an asterisk over here and you can see this date is extended till 31st March 2022 through a CBDT circular 16/2021. So in the law, the date is this only. In the law, the date is this only. But as per the CBDT circular, the date is now what? 31st March 2022. Okay. Is it clear? You can write it over here if you want. I am not writing over here because I want to put the provision first and then a circular separately below. So that you come to know that this is not a change in the law. This is the change through a circular. This is a relaxation given through circular by the government of India. Okay. So all the existing trusts have to mandatorily apply till 31st March 2022, which is gone now. Okay. So I hope everybody would have applied. Once the SSC has applied, suppose the SSC applied on 31st of March 2022, suppose. Then the department will grant registration till which date? Within 3 months from the end of the month in which the registration application is uploaded. Suppose the SSC has uploaded in March. Then the department has to give the registration till 30th June. So in whichever month you will upload the registration certificate, in whichever month you will upload the application, within 3 months the department has to give you the certificate. Okay. Is it clear? I'll give you the example proper. Don't worry with the numbers. Third, from which year the exemption will be available? From the AY from which the trust or institution was earlier granted registration. So the trust will obviously get exemption from the earlier only. Earlier also trust was registered. Now it is an existing trust. So exemption will be available from earlier year only. It is not that the exemption will be available from now. Earlier exemption will be denied. No. You can enjoy exemption in earlier year as per the old provision and in the new year as per the new provision. And for how many years the exemption will be available? Maximum 5 years. Validity of registration will be 5 years. After 5 years, you have to come again and reapply. Okay. So this is the first case. Let me explain you with the help of example now. Okay, application and registration of trust. I have made this. You can take a photograph of this after some time. Just wait. What is the last existing trust? First case, existing trust under 12AA. All those who are already existing under 12AA, there might be lakhs and crores and thousands of trust over here. I don't know the exact number. By when all of them have to come? All of them have to mandatorily come by 31st of March 2022. They have to mandatorily apply for application till 31st March 2022. Last date by which the registration will be obtained. Once they apply within 3 months, that is till 30th June 2022, they will get the registration. Exemption available from which year? From the AY when it was registered earlier. They will get the exemption from that year. Number of years is how much? Number of years is 5 years. I hope it is clear to all of you. This will give you a crystal clarity of the provision. Just check it once. Take a photograph of this once. Do write it down in your notebook, please. Please. You have to write it down. Is it clear? So all the existing trusts. Close your eyes and think. There might be thousands and lakhs of existing trusts. All of them have to come to the department once again. They are making the work hectic. Earlier, the time limit was 30th June 2021, but the COVID has said that no, you have to extend it. I have come again. It has to be made till 31st March 2022. So they extended the date of application by 31st March 2022 and last date by which the registration will be obtained 3 months after that. Okay. Now let's move on to the second case. Which is the second case? Second case is an absolutely new trust. New trusts which are not registered under 12A or 12AA up to 31st March 2021 or any other trust not covered by this table. So this is talking about a new trust. Now here there is some kind of problem which I can encounter and I can tell you all. I'll tell you, don't worry. I'll tell you the problem also over here. There is some issue over here. So I'm an absolutely new trust. So when should I apply? This column is telling you when should I apply. This column is telling you from till when they will give you the registration. This column is telling you from which year you will get exemption. And this column is telling you for how many years you are getting an exemption. So step by step, let's talk. First of all, case 2. Case 2 talks about what? A new trust. When should I apply? At least 1 month prior to the commencement of the previous year relevant to the assessment year from which the registration is sought. Okay. So from whichever year you want the registration, you have to come 1 month prior to that. Suppose if you are willing to take registration from previous year 22-23. Okay. If you are willing to take registration from previous year 22-23, then you have to take 1 month prior to that. That is till 28th of Feb 2022. Again, I am saying, suppose if you are willing to take the registration from previous year 22-23, you have to come 1 month prior to that. That is 28th of Feb 2022. Let me show you the example. With the help of numbers, we'll try to understand. New trust. Suppose the trust wants registration from 22-23, PY 22-23 and AY 23-24. What is the last date for application? 1 month prior to the previous year, relevant to the assessment year for which the registration is sought. Okay. 1 month prior to the previous year, relevant to the assessment year for which the registration is sought. Okay. So we are sorting the registration for previous year 22-23, assessment year 23-24. So you have to come 1 month prior to the previous year. Check that. Check that. At least 1 month prior to the commencement of the previous year, relevant to the assessment year from which the registration is sought. Okay. So for previous year 22-23, you have to come by 28th of Feb 2022. So I made an application. What next? By when I will get the registration? Within 1 month from the end of the month in which the registration application is uploaded. So I uploaded the application in which month? February 2022. So I will get the registration by which month? March 2022. You will get the registration check. Will get the registration from March 2022. Till here everything is same and everything is perfect. I have no issue with that. I have no issue till here. My issues will arise now. Now my issues will arise. Just wait for some time. How my issues will raise now. When I raise the third question, at that time in this column I will be having an issues now. What does the third column says? Third column says that from which AY you will get the exemption. Right? This is what the third column says, right? Let's see. from the AY immediately following the FY in which the registration application is uploaded. Now, when I have uploaded the registration application, I have uploaded the registration application in previous year 21-22 for your kind information, because I have uploaded the registration application in February 2022. So they are saying you will get exemption from AY 22-23. As per this column, it is coming to 22-23 AY. As per this column, it is coming to AY 23-24. If you see both the columns, there is a mismatch in both the columns, because this column says that, let's see, just wait. This column says what? You should make an application 1 month prior to the previous year in which you are wishing to take the registration. So I am wishing to take the registration from 22-23. So I made an application 1 month prior to that. That is on 28th of Feb 2022. So I should get registration from 22-23 PY, 23-24 AY. But when I come to the third column, it is saying that the month in which you applied for the registration from the next AY, which is the next AY, that is 22-23 AY. From that year onwards, you will get exemption. So there is a great mismatch between the two. Check. So as per the third column, the answer which is coming is AY 22-23 and PY 21-22. And as per the first column, the answer which is coming is this. This is a mismatch between the two laws. And I am not saying that. A lot of people are saying that this is a mismatch. Because as per the first column, the law is saying what? You should make an application from which date? It's very clear here. The law is saying that if you want registration from this date, then you should make an application 1 month prior to that. I have made that. Then later on also the date should come to same only, na? It cannot be 1 year before that. I don't know whether you understood this. As per the first column, the law is saying that from when you want registration, I said from PY 22-23 I want. So the government said that make an application 1 month prior to PY 22-23. So I made an application on 28th Feb 2022. Now when I come to the third column, the law says that when you have uploaded the application, the next AY from that you will get the exemption, which is the next AY after I upload the application, AY 22-23. So here there is a mismatch. Just check it once. Just check it once and take a photograph of this. Take a photograph of this. Okay. I hope it is clear to all of you. If you don't find a mismatch, that's great for you. Okay. Now let's move on to the third case. You have to understand all these things with the help of examples only. A third case also there is a mismatch. I am not saying, taxman is saying. Now suppose the trust is provisionally registered. Here you will get what? Provisional registration for 3 years from the AY from which registration is sought. You are going to get provisional registration, as I have told you. Now the government is not going to give final registration directly. First they will give you provisional registration. They will check your activities, whether you are genuine or not. And if you are genuine, they will give you final registration. If you are not genuine, they are not going to give you any registration. After 3 years, Tata bye-bye. Go. Now, once you are provisionally registered for 3 years, after 3 years, you have to again come and make an application, right? So this is case 3. Case 3 is for people who are provisionally registered for 3 years. Okay. Trust which is provisionally registered under 12AB. So when are they supposed to make an application for the final registration? At least 6 months prior to the expiry of the provisional registration. Whenever the provisional registration is expiring, suppose the provisional registration is expiring in 23-24. You have to come 6 months prior to 23-24. Okay. Or within 6 months of the commencement of its activity, whichever is earlier. And I'll just speak about it in a while. When should I make an application? I have said to you about the application. When the government will give me the registration? Within 6 months of the registration application is uploaded, they will give me the registration, final registration. Okay. For how many years I will get the registration? 5 years. For 5 years. And how the 5 years will be counted? 5 years will be counted including the 3 years provisional period. So I'll be getting the final registration for only 2 years because already 3 years I have enjoyed under provisional registration. Okay, so I'll be getting the registration only for 2 extra years because 3 years I have already enjoyed under the provisional mechanism. So 2 years extra I'll get final registration. Just wait, we'll talk about one by one, step by step. Let's talk about the first column first. I am provisionally registered. What am I supposed to do? Let's take an example and try to understand. We'll come to the column with the help of an example. Now suppose case 3. 3 years for provisionally attached, not registered trust. 3 years for provisionally registered trust will expire on 31st March 2024. For example, the 3 years are expiring on 31st March 2024. So now, with the help of this, by when I should make an application? At least 6 months prior to the expiry of the provisional registration. Till here, everything is fine. I have no issue with this line. I have issue with this line. I have issue with this line. I have no issue with this line. The line which I have highlighted, I have no issue with that. I have issue with the line which I have circled and I have striked off. I'll tell you why. First of all, let's try to evaluate, understand this. At least 6 months prior to the expiry of provisional registration, you are supposed to make an application. So, this is the expiry. At least 6 months prior to this. It means by 30th of September 2023, I am supposed to make an application. This is the first date. I have no issue with first date. I have issue with the second date. What is the second date? The second date says that within 6 months from the commencement of its activities, whichever is earlier. Okay. So the second date says that this date or this date, whichever is earlier. Now suppose the trust has commenced its activities. Suppose the trust has commenced activities 10 years back. Then this point is illogical today. This point is illogical today because this says that 30th September or within 6 months from the commencement of activity, which is 10 years before, whichever is earlier. How can I go 10 years before and make an application? They should have mentioned whichever is later, or they should have not mentioned this point only. Suppose the trust is open 10 years back. Okay. And now they are coming back for a provisional registration. Then how this point will be proved in practical life? Please tell me. How this point will be proved? I have no issue with the third point. I have no issue with the first date. First date is absolutely fine. What does the first date says? Whenever your provisional registration is expiring, in our example, 31st March 2024, you can make an application 6 months prior to that. I am absolutely fine with that. But the second date says that, or within 6 months of the commencement of activity. What if the commencement of activity was done 10 years back? Then how will I go 10 years back and make an application? Because the provision says that whichever is earlier. This point is absolutely nonsense. This point is absolutely pathetic, illogical. I am not saying that. You can go and check the taxman. It is given in the taxman's reckoner also. And I think so in master guide also. The government has not rectified so far. They have not rectified because this provision has very recently come into operation. Once they will find this practical difficulty, they will definitely amend all these things in the next 2-3 years. You can check. You can vouch for these things. They will definitely amend these things in the next 2 years, or they will come with some clarification. Okay. This is the problem over here. Let's see the third column. From which year I am going to get the exemption? From the first of the AY for which it was provisionally registered. Okay. So you will be getting the exemption from the first AY. Date of registration is 31st March 2024. Okay. From which year you are going to get the registration? Okay, sorry. Just wait. Once I have made the application. Suppose I made the application 30th September. In how much time I will get the registration? within 6 months from the end of the month in which the registration application is uploaded. So the registration application is uploaded on say 30th September 2023. So within 6 months from this date will come to this date and you will get a registration by 31st March 2024. From which year you are going to get the exemption? From the earlier year in which you made an application for provisional registration. You are going to get 3 years provisional and 2 years extra, total 5 years. I hope it is clear to all of you. You are not going to get another 5 years from 2024, please. 3 years already you have enjoyed in provisional registration. So 2 more years you will get final registration, and after 5 years you can again make an application, okay, for a re-registration of another 5 years. Just take a photograph of this, please. Everywhere they have made a blunder. I am not getting into the further detailing. Otherwise, I can find out blunder at every place. Okay. Let's move on to the fourth case now. Trust which is registered under 12AB. As I have told you, a trust which is registered under 12AB, are they supposed to again come back and give us an application for registration? Why, sir? They are already registered, na? They have to come back after 5 years because now it is not lifetime. It is for some years, 5 years maximum. When they will come? At least 6 months prior to the expiry of registration under 12AB. So let's see with the help of an example this also. Case 4. Suppose the registration under section 12AB expires on 31st March 2024. Okay. Then by when I should make an application? At least 6 months prior to the registration under 12AB. Make application till 30th of September 2023. Okay. This is very simple case. Nothing great. Once I make an application, then for how many, then in how many months they will give me the registration? They will give you the registration within 6 months from the end of the month in which the application is received. So registration till 31st March 2024. They'll give you registration within 6 months. And from which year? Exemption. Sorry, not exemption. For how many years? Exemption will be available. Obviously for 5 years, another 5 years. Okay, for another 5 years. Okay, because you are already registered here. So after 5 years, another again I am supposed to come. Yes, every 5 years you have to come to the department. Okay, so this is a very simple case. There is no issue in that. There is no mistake in that. Everything is fine. You can take a photograph of it. So now let's move on to the fifth category. Okay, fifth case. Pay attention, please. The case 5 is what? The case 5 is related to something which we have done in the last lecture. Okay. That first, you are enjoying the approval under section 1023C or 1046. You are enjoying this. Okay. Now, do you remember, if you enjoy this, then you cannot come back to 12AB. You cannot come back to 12AB. Now you want to come back to 12AB. So you are giving up the approval under section 1023C or 1046 from 1st April 2022 or 1st April 2023. So you are giving up that because you want to enjoy what? Not 12AB you want to enjoy. So now the application for should be made till where? Application till when? Let's see that particular thing. In case 5, pay attention please. So trust, the registration of which has become inoperative due to 11.7. Do you remember it was mentioned in 11.7? This was the last provision which we did in the last lecture. Then you have to make an application at least 6 months prior to the commencement of the AY from which the said registration is sought to be made operative. Okay, so you have to make an application at least 6 months prior to the AY from which the said registration is said to be operative. Okay, now pay attention please. Now pay absolute attention. You have to make an application. So you want the registration from which PY? You want the registration from PY 23-24, right? That is from PY 24-25. So you have to, sorry, from AY 24-25. So you are giving up on this date, right? So you want registration from this date under 12AB. So you want registration from PY 23-24 because from PY 23-24 you will not get this benefits, okay? Because you are giving up on 1st April 2023. So here the time limit is within 6 months from the end of the AY. Check the words very clearly. Here they have given very clearly within 6 months from the end of the AY. Within 6 months, sorry, with at least 6 months prior to the commencement of the AY from the said registration in which it's said to be made operative. So you have to make an application within 6 months from the commencement of AY. When is the AY commencing? AY is commencing on 1st April 2024. So you have to make an application till 30th September 2023. Is it clear? Within 6 months from the commencement of the AY. Okay. Then once you make this application, you will get registration till when? Registration. This is first point. This is first, second point. Registration till, that is the same time limit within 6 months, I guess. That is the same time limit within 6 months on the end of the month in which the registration application is received. Okay. So that will come to the same 6 months date. That is 31st March 2024. You will get the registration and then you can enjoy the exemption for how many years? For 5 years. Okay. You can enjoy the exemption for how many years? For 5 years. You can check over here. Okay. I hope it is clear to all of you. So this covers which case, which we have done in the last lecture. If you remember that you cannot enjoy both. You have to enjoy one of them. You cannot enjoy both. And if you again want to come back, then you have to what? Give up the approval and the notification under 1023C and 1046. Okay. So this is what your case 5 is all about. Just take a photograph of this first. The case 6 is very simple. I am not going to give any example also on that. That is very, very simple. That we can write there itself. It will take time for you to understand these things. We have taken days and days to understand these things when it came for the first time. And we have tried to encounter the mistake in that. Okay. Don't be under an impression that once you listen, you will remember everything. No, you go through 2-3 times, you will remember. Don't worry. Okay. Now, one last thing is over here, that what is the last thing? Suppose a trust is registered now. Trust is registered. With some objects. Now, after few months or few years, they want to change their objects or they want to modify their objects. Suppose they are school, now they want to bring some college also, they want to start some hospital also. They want to change their object or they want to modify the object. Is the assessee supposed to make a fresh application? The answer is yes. If the trust change the object or modify the object, they have to make fresh application within 30 days. Okay, just check it. The focus has to be here on what? This is which case? The last case. There's a modification of the objects which do not conform with the conditions of registration. Then within 30 days from the date of the said adoption or modification. Okay. So they have adopted new object or they have modified the existing object. Within 30 days you have to make an application. Okay. Then within 6 months you will get the registration. Rest of the things are same only. And then for 5 years you can enjoy the activities of the trust. Okay. So the rest of the things are same only. So don't worry about it. Okay. Is it clear? So if there is a change in object, then you have to make an application. Definitely you have to make an application within 30 days from the date on which you are adopting a new object. Adopting a new object means you were not doing that activity. Now you are doing that activity also. You were engaged into school. Now you are engaging into a hospital also. So that is adopting a new activity. Changing an object means in existing activity you are making some changes. That is modification. So there are two words the government is using. Adoption of a new object or a modification of an existing object. So in both the case, you have to make a fresh application within 30 days. They will give you a fresh registration within 6 months. Okay. And then you have to do what? You have to enjoy the exemption for the 5 years. Obviously, after 5 years, everybody has to come back. So this is what the registration provision is all about. There are a few more points which I have to speak. Now, out of the 6 points, the first 4 points, you can see there is a double asterisk over there. 1, 2, 3 and 4. Now these 4 points in exact manner is also applicable to a 1023C institution and ATG trust. To a 1023C, institutions which are registered under 1023C or the trusts which are registered and eligible to take donation under ATG, they are also supposed to follow the first 4 points. First 4 points means if they are an existing trust, they have to make a fresh application. Same time limit, everything is same. Everything is same for them also. So this provision is not only applicable to a charitable and religious trust, but this is also applicable to 1023C trust and ATG trust. They also have to follow this new regime of what? Registration under the income tax law. Okay. So this is what the provision of registration is all about. Now pay absolute attention, all of you. Pay absolute attention. Now pay absolute attention. Suppose an assessee makes application on say 15th of June 2022 for first time. Okay, for the first time. He's making application for the first time. Okay, so if he's making application for the first time, which is the relevant case for us? The second case is the relevant case for us. Okay, so if he's making application on 15th of what? June. So registration will be granted from when? Registration will be given on which date? Maximum which date? The government has said within 1 month from the end of the month in which the registration application is uploaded. I will get the registration within 1 month. Okay. So by 31st of July 2022, I will be registered trust under 12AB. Okay. Now the question is, from which year? I will enjoy exemptions. Okay. That is written in the third and the fourth column. Okay. Pay attention. From the AY immediately following the FY. in the registration application is uploaded, I'll be getting the exemption from that AY following the FY in which the application is uploaded. Application is uploaded in which FY? Application is uploaded in FY 22-23. Okay. So I will enjoy the exemption from AY 23-24, right? That is PY 22-23, right? This is what the provision has to say. Am I wrong or am I correct? I am absolutely correct. Don't worry about it. I am going as per the law. AY PY 22-23. Okay. So if you connect these two dots, you are enjoying exemption from the same financial year in which you made the application, right? If you are making an application on 15th of June 2022, you can enjoy the exemption from previous year 22-23 itself. You can check with the second case. Just check it once, then only I'll go ahead. Otherwise, I'll not go ahead. Just check it once. Okay. Okay. Now there is one question with the assessee, with the assessing officer. Sir, who grants you this registration? This registration is granted by CIT. Okay. And once the registration is granted, as you can see, registration is granted for current year and future years. Right? It is granted for current year and future years. Now the assessee has one question. The question is, can I get the exemption for past years also? Can I get the exemption for previous year 18-19, previous year 15-16, previous year 16-17, previous year 17-18? Can I get that? Can the department be so lenient on me? Can the department be so merciful on me that they give me exemption for the earlier year also? Can they do this much for me? Can they do this much for me? This is the question which is raised by the assessee. Because there are so many trusts in this country who are doing so good activities, so good deeds, but they are not registered. They came to know in the current year that we have to register under income tax law also. So in the current year they came to income tax law, they got registered. So income tax law very clearly says that whenever you come for registration, we will give you exemption from that year and future year. What about the past years? Can I get the exemption for earlier years also? I am into the activity of trust since last 20 years. Can I get the exemption for earlier years also? So the government has made some provisos. Yes, there are some provisos who can give you benefit. Okay, take a photograph of this. This will first of all give you a clear picture of exactly what is the issue. Then you will understand how to solve that issue. Okay. Now there is a proviso which is put below the provision. Okay. Proviso under 12A. A trust can enjoy exemption for preceding year if on the date of registration. If on which date? On the date of registration. Which is the date of registration here? This is the date of registration. Just a second. If on the date of registration, the assessment for the preceding year is pending in front of AO. So if your earlier year assessment has to be pending in front of AO and the objects, second condition of the day on the date of registration and preceding years are similar, then we will give you benefit for the earlier year also. If the assessment for the earlier year is pending on the date of registration in front of AO and your objects of earlier year and objects of today is similar, we will give you exemption for past years also. Don't worry. We will give you exemptions for earlier year also. Don't worry about it. Don't worry. So what are the conditions that you are supposed to follow? On this date, you are supposed to follow two conditions. Assessment of past year is pending and objects are same. So if assessment year of 16-17 is pending on this date, plus objects are what? Similar, then you can enjoy the benefit for previous 16-17 also. So on the date of registration, the entire catch, the most important date over here is the date of registration. On the date of registration, whenever you get the registration now, on that date, sit on that date and check which all your assessment is pending. If the assessment is closed, then nothing can be done. If it is closed, then nothing can be done. On the date of registration, suppose we got the registration in our example on 31st of July. So sit on 31st July and just check. Okay, what is the status of 15-16? Closed. Then leave it. 17-18? Closed. Then leave it. 16-17? Pending. Okay, now check the objects also. Is the object similar? Yes, similar. Now you can take the exemption for 16-17 also. Okay. This is the benefit which is given by second proviso to section 12A. Sir, but there is no actual registration now in 16-17. Don't worry. This proviso will give you the benefit. Sir, what if later on AO says that you have escaped income under 147 and he will raise 148 notice with me? He will not do that. Third proviso will stop him. Check. He cannot do that. It is further provided that no action under 147 shall be taken by AO in case of a trust for any preceding year. AO cannot take any action against you. Only for the grounds of what? Non-registration. So if the trust is not registered in 16-17 and earlier year, then the AO cannot raise this question that you are not registered. How the hell you are taking the benefit? He is taking the benefit as per second proviso. Nobody can stop the assessee to take the benefit. The second proviso is giving the benefit and the third proviso is protecting the benefit. So the AO does not have the right to what? Raise any question over here. The only thing which you have to see is on the date of registration. See which year assessment is pending in front of AO. Any assessment, regular, best judgment, 147. They have not mentioned the nature of assessment. When I say assessment, all assessment will come. Any assessment of earlier year is pending on the date of registration? Yes, it is pending. Are the objects same? Yes, the object. That is also school, now also school. That is also college, now also college. That is also hospital, now also hospital. That's it. You can take the exemption for earlier year. Sir, if the later on AO will say you are not registered, still you took the exemption, don't worry, AO cannot say anything. He cannot open 147 because of this reason. He can open 147 because of some other reason. But for the grounds of non-registration, he cannot open. He cannot open. So these two provisos are what? These two provisos are beneficial or harsh to assessee? Tell me. These two provisos from year till year are beneficial or harsh? Are absolutely beneficial to assessee. And it is giving you the benefit to go back and take the exemption. Because by default, the main provision which is in the chart only tells you to take the benefit for future years and current year, not for the past years. As we have seen in the example, that it gives you registration exemption from the year in which you make the application, not for the earlier year. This proviso takes you back and gives you the benefit. What will happen because of this? There are a lot of people who can come forward for registration. They will be very happy that if we get a registration today now, then we can get the exemption for earlier years also. We can get the exemptions for earlier also as per the second proviso. Now the fourth proviso is harsh to you. It is very genuine also. Why? It says that it is also provided that the benefit contained in above proviso shall not be available if the assessee was refused registration earlier or it was cancelled earlier. It means in 16-17 you came with an application and the registration got refused. Then you cannot come in 22-23 and say that give me the benefit of earlier years. Obviously not. There would have been some reason for refusal in earlier year now. So in 16-17 you came for the application. The registration certificate was registered, was refused. So in 22-23 you again came. Now it got accepted. So now you cannot take the benefit of that proviso. That second and third proviso. The second and third proviso benefit is only available if earlier the registration is not refused or if earlier the registration is not cancelled. If earlier the CIT has refused the registration, there would have been some genuine reason to refuse. Or if the CIT has cancelled the registration, there would have been some genuine reason to cancel. If it was refused earlier or if it was cancelled earlier, you please do not come over here to us. Okay? I hope it is clear to all of you. So this is what section 12A and 12AB is all about. It is not completed. Just go through this once. Just go through all the examples once, pause the lecture, and then we'll go ahead with the next part because there are some amendments over here made by Finance Act 2022. In today's lecture so far, there was no amendment. Okay. So now let's move on to the next part. Pay attention, please. What is the next part? All of you pay attention. There is an AO over here. There is a trust over here. And suppose the assessment of this trust is going on. And the AO finds that this trust is doing some specified violations. This trust is doing certain specified violation. Then the AO can make a reference to the Commissioner of Income Tax, and then Commissioner of Income Tax will look into the matter whether a specified violation has happened or it has not happened. And then the Commissioner will pass an order to what? Either cancel the registration or not cancel the registration. So here the AO will look into the activities of the assessee. AO will look into the genuineness of the trust, whether the trust is working properly or not. And if he finds certain specified violations, he cannot suo moto disallow the exemption. He has to make a reference to the CIT. CIT will look into the matter, will check the genuineness, check whether the specified violation has actually happened or whether the specified violations have not happened. If specified violations have happened, he will cancel by passing an order. And if specified violation have not happened, again he will not cancel. He will refuse the AO's reference. He will tell the AO to go back and he will pass an order. And he will tell the assessee, continue your activity. You are absolutely. In this entire procedure, you will ask one question. What do you mean by the term specified violation? You remember that long back I have told you this issue while teaching you the chapter of assessment under 143.3. You can check this over here. I'll show you. In your book 1. Check this. This is 143.3. There was one proviso where AO is satisfied that any fund under this or trust under section 11 or 12AB has committed any specified violation. At that time also I have told you that he shall send a reference to PCIT or CIT to withdraw the registration, and then AO shall pass the order after giving effect to such withdrawal. See along with the taxation of trust. So today is the time which has come to understand this particular provision in detail. Okay. So today is the day which we were talking about in that particular lecture. I hope it is clear to all of you what I am trying to say. So what is the specified violation? Now, so the government specified violation was not there till last year. Finance Act 2022 has defined the term specified violation. It was not there till last year. It was absolutely not there till last year. Till last year it was missing in the law. Now they have put it in the law. Okay. So be very careful about it. Shall I speak? Shall I speak? So let's start with the specified violation. And this is applicable to both the regimes. Okay. to regime 1 also and to regime 2 also. That is to 1023C institutions also and 12AB assessees also. Regime 2. Section 12AB has been substituted. The substituted subsection 4 is applicable in case of a trust or institution which has registration or provisional registration. And subsequently, the PCIT has noticed occurrence of one or more specified violation during the previous year. So the PCIT himself has noticed. Suo motu has noticed. PCIT can suo motu also notice any specified violation, or PCIT has received a reference from the AO. So these are the two possibilities. One is where PCIT himself has noticed some specified violation. Second is where he has obtained some reference from the AO under the second proviso to 143 which I just showed you. Or the case has been selected in accordance with the risk management strategy formulated by board. Do you remember risk management strategy formulated by board, which I have told you in 147, like SFT, like AIS? Do you remember in 147, I have told you that if the AO gets an information through a risk management strategy, then it can be a sufficient information for AO to initiate 147. So, there are three possibilities through which the PCIT can come to know. First, the PCIT can suo motu come to know. PCIT has observed that, has noticed that, or AO has made a reference, or they have got it from the CBDT information system, like annual information system, or a statement of financial transactions. They can get it from either of the two. In the aforesaid cases, the PCIT shall call for the documents or information from the trust or make such inquiry as he thinks necessary in order to satisfy himself about the occurrence or otherwise of specified violations. So the commissioner will call the trust, will tell the trust to come and give all the documents, give all the necessary information, because I want to satisfy myself. The PCIT is saying, the CIT is saying, I want to satisfy myself whether you have done any specified violations or not. I want to satisfy myself about it. Okay, so they have to give all those data and information. And then PCIT will pass an order cancelling the registration of such trust after affording a reasonable opportunity of being heard for such previous year and all subsequent previous year. If he is satisfied that, when he will cancel? If he is satisfied that one or more specified violation has taken place, so he will cancel the registration if he is satisfied that there is a specified violation. But out of all this thing, the question is, what is specified violation? We will see that now. The definition of specified violation is here. So in this point, he is cancelling. But in third point, he is not cancelling. He is refusing to cancel. If he finds that there is no specified violation, pass an order refusing to cancel. He is not cancelling now. He is allowing the registration of such trust or institution if he is not satisfied about the occurrence of one or more specified violation. So he can do either of the thing. He can cancel also if he is satisfied that violation has happened. If he is not satisfied that violation has happened, he will not cancel the registration. Obviously, he is not mad to cancel your registration. And then he will forward a copy of the same to AO and to the trust, that I have cancelled or I have not cancelled. So both the things he has to do by passing an order. Cancellation also has to be done by passing an order, and refusing to cancel also has to be done by passing an order, as I have told you in this particular chart. Can you see this? Pass an order for both. Okay. Now, this is the procedure. Nobody is going to ask you this in exam, obviously. They can ask you one question definitely, that what is the specified violation? What is specified violation? He can ask you that question definitely. Okay. 110% they can ask you that question. So there are around 6 points which are mentioned by the law, which can be considered as what? Specified violation. And sir, what is the time limit to pass this order by CIT? That also we have to see. We'll see in a while. Okay, first of all, let's see the most important part. Amendment made by Finance Act 2022. Everything, all these things are amendment. Earlier that this provision was just in one line. This was just a one-liner provision. Now the government has given in depth about this provision. So let's see the specified violation. First, the term specified violation means the following violations, where any income of the trust or institution has been applied other than for the objects for which it is established, has been applied for other than the objects of the trust. So if the CIT observes that the trust is applying the money of the trust for some other objects, not for the objects of the trust, it is a specified violation. You should apply your money for the objects of your trust and not for other purposes. You are not supposed to apply your money for other purpose. You are a school, apply for the purpose of the school. You are a college, apply for the purpose of the college. If you are applying for other purposes other than the objects for which you are established, then it is a specified violation. If it is a specified violation, your registration might get cancelled. And practically, once it is getting cancelled, now you don't get again. Practically. Second specified violation. The first is what? Income is applied other than for objects. Second one, the trust or institution has income from PGBP, which is not incidental to the attainment of its objects, or separate books of accounts are not maintained by it in respect of business which is incidental to the attainment of its objective. Now, what do I mean by this? A trust can definitely do PGBP. There is no harm, like a school. School is a trust and that school is a business also. But that school that business is what? Incidental to your objects. Now, if that school is doing some other business only, which is not incidental to the object of giving education to the children, now that school is doing some business of what? Some business of giving banquet. There are a lot of schools now who do what? Who give their open space for wedding and all. They do or not for wedding and all. So you have to maintain separate books for that. If you are not maintaining separate books for that also, then in that case you will be considered as a specified violation. The specified violation. So I have a school which is registered as a trust. I am charging fees to the students. That is all fine. There is nothing wrong in charging fees to the students. So I have to maintain separate books for that. Apart from that, to earn some extra revenue, what we do? We give the open space of the school during holidays and during night time for weddings and all. You do that, but maintain separate books. Otherwise, it will be a specified violation. Check. Third one. The trust or institution has applied any part of its income from the property held under a trust for private religious purpose which does not inure for the benefit of the public. What do I mean by private religious purpose? The trust has applied any part of its income for private religious purpose. There are two types of religious purpose. One is a public religious purpose which is registered as a public charitable trust, like Vaishno Devi Mandir, like you can say, for example, Balaji Temple, like for example, Golden Temple, like for example, if you come to Mumbai, then there is a Siddhivinayak Mandir, there is a Haji Ali Dargah. All these are registered trusts. Like there is a Mount Mary Church, Guru Nanak Gurudwara. All these are registered trusts. If you are incurring your money for them, then it is okay. But for private religious purpose means what? You are opening a mandir at your home and you are incurring an expense on that and you are saying that this is Bhagwan. You are opening a masjid at your home and then you are incurring an expense and you are saying this is Allah. You are opening Gurudwara at home and then you are incurring expense. You are saying this is Guru Nanak. This is our Lord. You are opening a church at your home. Everybody has that small space of religious purpose at home. Now that is a private religious purpose. So if you are incurring the money for that purpose, which is not for the benefit of the public, but only for your benefit, you are committing a specified violation. Please don't do that. Please. What is the first specified violation? You are applying your income for other than the objects. Second specified violation. You are doing business. There is nothing wrong in doing business, but that business is not incidental to your what activities of the trust. Third, you are incurring your money for private religious purpose. Fourth one. A trust or institution established for charitable purpose, created or established after the commencement of this act, has applied any parts of income for the benefit of any particular religious community or caste. You should not be very biased towards any community or caste. Cannot do that. Cannot say that my trust will only benefit this community only. My trust will only benefit this community only. You cannot say that. I will only benefit to my community, Shetty community. Band Sangh. Shetty communities has a Band Sangh. In Mumbai, I don't know at your South India they have it or not. But in Mumbai, the Shetty community has a. I have been into an articleship with a boss who is Shetty, so I know all those things in detail. There are a lot of my Shetty friends also. They have a Band Sangha. That is an association of all the Shettis. You cannot do that. It's a specified violation now. You can bear the tax and do that. Then you will not be eligible for registration. They will cancel your registration. Point number E. Any activity being carried out by the trust or institution which the CIT feels that is not genuine or is not being carried out in accordance with all or any of the conditions subject to which the registration was granted. The CIT is of the opinion that your activities are not genuine. The CIT is of the opinion that you are carrying out activities which are not as per the objects of the trust. You are doing something else only. You are doing something else only. The application when you made for registration, in that the objects were different. Now the objects are different. Your activities are not genuine. Specified violation. Last but not least, the trust or institution has not complied with the requirement of any other law or order or direction or decree by whatever name called, holding that such non-compliance has occurred, has either not disputed or has attained finality. It means you are breaking some other law. You are not supposed to break other laws also. Like for trust, there is a law which is applicable for trust. Other law, Foreign Contribution Act. Because the trust gets donation from outside India, they have to comply a lot of things for foreign donation. So if they are not complying lot of things, lot of conditions which are mentioned in the Foreign Contribution Act, it's a violation of any other law. You are not supposed to violate other laws, other orders, other decree. Decree means an order which is given by a court. You are not supposed to violate other laws, other orders, other decrees. If you are violating other laws, other orders, other decrees, it's a specified violation. So these are the 6 points which you have to by heart, please. I don't know if they can ask this directly in the exam. They can definitely ask this. It's a very, very recent amendment, so it can be asked in exams. Now the question is, within how many months the CIT will pass the order to cancel the registration or to refuse to cancel the registration, either of the case. The aforesaid order shall be passed before expiry of 6 months. It's a very different time limit and calculated from the end of the quarter in which the first notice is issued by PCIT on or after 1st April 2022. It's 1st April 2022. Calling for any documents or information or for making inquiry. So if the CIT is sending you notice on 15th of May 2022, then you will count 6 months from where? From the end of this quarter. It means you will not count from May. You will count from 30th June 2022, 6 months. Okay. Therefore, the last date will come to what? 31st December 2022. Because they have said within 6 months from the end of the quarter, not from the end of the month now, in which the first notice is issued by PCIT on or after 1st for 2022. If the notice is issued on this date, then from this quarter end, 6 months time limit will be given to you. Just take a copy of this. Just write down this. Okay. So this is what your registration procedure is all about. Here we complete the entire registration procedure completely. Okay. Just go through it once if you. So now let's go ahead with the next part. How a trust will compute its capital gains. Let's talk about that now, beta, all of you. Now this is a very important provision. I don't know why ICI has been asking this provision again and again, but they like this provision for some of the reasons. How a trust will compute its capital gains. Pay attention, please. Suppose a trust is selling a capital asset. Suppose the full value of consideration is 9,30,000 rupees. Less expenses on transfer is 30,000. So this will come to 9 lakh net sale consideration. Minus cost of acquisition is say 6 lakhs. This 3 lakhs will be what? The capital gains of the trust. Okay. Now if trust want the exemption, if the trust wants to save capital gains on this 3 lakhs, the government is making a very simple provision. The government is saying that whatever money has come to your pocket as a net consideration, buy a new capital asset out of it. I am again repeating. The government is saying you want to save tax on 3 lakhs. I said yes. The government is saying listen to us. Whatever money has come to your pocket in the form of a what? In the form of a net consideration. Whatever net amount has come to your pocket, buy a new asset of that much amount or higher amount. So if the assessee buys a new capital asset of rupees how much? 9 lakh or more, then entire capital gains of 3 lakh is exempt. So you should buy a new capital asset of 9 lakh or more, then your entire capital gain will be exempt by the government. Okay. So what if I do not buy a new capital asset of 9 lakh? I buy of say 6 lakhs or I buy of 7 lakhs. So listen carefully. If the new capital asset is of less than rupees 9 lakhs, then exemption will be as follows. How much? Cost of new asset minus cost of old asset. Suppose if I buy a new asset of 7 lakh minus what was the cost of old asset? 6 lakhs. Then exemption will be only 1 lakh. And 2 lakh will be what? Taxable. It is as simple as this. So if you want to save the tax on 3 lakh rupees, then you have to invest the entire 9 lakh rupees in the new asset. If you invest 9 lakh or more, then entire 3 lakh will be exempt. If you invest less than 9 lakh, if you invest 7 lakh, then 7 minus 1 lakh will be exempt. If you invest 8 lakh, then 8 minus 6, 2 lakh will be exempt. If you invest 8.5 lakh, then 8.5 minus 6, 2.5 will be exempt and 0.5 will be taxable. It's a very simple mechanism as you can see over here. Okay. Now there is one more thing which the government is saying. If you invest greater than net sale consideration, that is suppose if you invest what 11 lakh, you are supposed to invest only 9 but 11. So this extra 2 lakhs now will be considered as an application of income. You can reduce as an application of income after 15%. You know that after 15% we take an application now. So this is what this provision is all about. So if you invest 9 lakh, then entire 3 lakh will be exempt. If you invest less than 9 lakh, then this is the exemption, balance taxable. If you invest more than 9 lakh, then in over and above 9 lakh will be considered as an application of income. Okay. So you just write down this over here. One point which is missing over here. Just write down over here. I am dictating. If an assessee invest, if an assessee rather reinvest, if an assessee reinvest in new asset, for more than net sale consideration, for more than net sale consideration, then the excess of 9 lakh and the excess of 9 lakh will be considered as an application of income. Will be considered as what? An application of income. Okay. So that's it. This is what this small provision is all about. Nothing great, but they have been asking this provision. I don't know for some or the other reason again and again. If you want, you can take a photograph of this. Anyways, this is also there in your book also. So it's not of much use, I guess. Okay. So now let's move ahead with the next part. And again, in the next part, there are a lot of amendments which are made by Finance Act 2022. Pay absolute attention on the board, please, all of you. What is there in the next part? Pay attention, please. The next part is about section 13(1). And what is section 13(1)? Section 13(1) tells you that do not do certain activities. Certain activities which are mentioned by the law, you are not supposed to engage in that. Otherwise, you are supposed to face harsh consequences. Okay, harsh consequences are to be faced by you. What are the activities which they are stopping us to do? So let's see the activities which they are stopping us to do. Pay absolute attention, please. Page number 54.10, all of you. Come here. Section 13(1) says that section 11(1) not to apply in certain cases. It means, what do I mean by section 11 not to apply? It means cannot claim what? Exemption in certain cases. You cannot claim exemption in certain cases. Now, which are those cases? You will not get the benefit of section 11 and 12 in certain cases. Now, which are those cases in which the government is not giving us the benefit of section 11 and 12? Let's see. Nothing contained in section 11 and 12 shall operate to exclude from the total income of the previous year of the person in the receipt of point number 1. Section 11 and 12 will not apply to you. Okay. In which all cases? Clause A, where you apply your income for a private religious purpose. If you apply your income for a private religious purpose, you will not be getting what? The exemption under section 11. Plus, you know that this is also called as a specified violation. And because it is called as a specified violation, your registration might also be cancelled. Exemption will be denied, registration will also be cancelled. Do you remember that one of the point was in applying the income for private religious purpose in specified violation? You will be gone with the registration also. Second point, if you are applying your income for a particular religious community, again it is a specified violation also. Your registration will also go, your exemption will also go. And sit quietly and follow the normal provisions of the income tax law then. If you apply your income for a private religious purpose, okay, or if you apply your income for what? Just a second. Some disturbance over. If you apply your income for a private religious purpose, that is the religious purpose which you are making at your home, etc., or which is not a registered religious trust, or if you apply your income for a benefit of a particular religious community, you will not get the exemptions under section 11 and 12. Third one, income applied for the benefit of certain specified person. If you apply your income for certain specified persons, so who are specified person? The government has defined the specified person on the next page. I'll show you who are the specified person on page number 54.11. In section 13 subsection 3, the government has defined who are the specified person. Let's see the list of the specified person. For the purpose of section 13, following are specified person: the author of the trust or the founder of the institution, The author or the founder means the person who is the main person who has started the trust, who has laid the foundation of the trust. That person is called as author of the trust. So if you are applying the income of the trust for the author of the trust, for the founder of the trust, you are doing something wrong. Or you are applying the money for a person who has made a contribution of an amount exceeding 50,000 during the relevant previous year, known as substantial contributor in the eyes of the law. If there is a substantial contributor who has contributed more than 50,000 rupees, you are giving benefit to that person only who is giving you contribution. He is giving you contribution, you are giving him benefit. He is giving you contribution, you are giving them benefit. What kind of trust it is? So you are doing a violation over here. 13 subsection 1 clause C will attract. Where such author or founder or substantial contributor is an HUF, then a member of an HUF, you are giving benefit to the member of an HUF. If the author is an HUF, if the founder is an HUF, if the substantial contributor HUF, and you are giving to the benefit to the members of that HUF. Which HUF? Who is a founder, who is an author, who is a substantial contributor. Next, you are giving benefit to the trustee of the trust or manager of the trust by whatever name called. Who is a trustee? What is the difference between an author and the trust? Author is the person who has laid the foundation to the trust. Trustee is the person who is running the trust today, who is the head of the trust today. Next, relative. Any relative of such author, of founder, substantial contributor, member, trustee, or any manager. The relative of all these people will also be considered to be specified person in the eyes of the law. Or any concern in which any of the person referred above has a substantial interest. Substantial interest means 20% stake at any time during the previous year. So a trust should not provide benefit to these people. To whom? First, should not provide benefit to author, should not provide benefit to substantial contributor, should not provide benefit to a member of an HUF. If an HUF is an author or a founder or a substantial contributor, should not provide benefit to trustee or manager of the trust, should not provide benefit to relatives of any of them, should not provide benefit to any entity. Suppose there is a partnership firm in which trustee has 20% stake, or the author has 20% stake, or the founder has 20% stake. Do not provide benefit to that concern also. That concern will also be considered as a specified person. Okay, now there are some amendments over here, very small amendment. Earlier, this point was only there in regime 2. Now it is extended to regime 1 also. Put it in the box. Now it is extended to regime 1 also. Plus, earlier what used to happen? Suppose the trust has an income of 100 crore rupees. Okay, listen carefully. And the trust has provided a benefit of 2 crore rupees to a foreign author. How much income trust has? 100 crore. How much benefit they have passed on to author? 2 crore has been passed on to author, which is a specified person. Wrong. What used to happen earlier? Entire income of the trust was not eligible for exemption. Entire. So if the trust has earned 100 crore rupees and has incurred 2 crore rupees for specified person, entire 100 crore was out of exemption. But now the government has made an amendment and said that only that part of income which has been applied in violation shall be included in total income. Check. Now the entire income will not be included in the total income. Is it clear? Is it clear? So earlier what used to happen, if a trust is earning 100 crore and is using 2 crore rupees for wrong purpose, 2 crore rupees for specified persons, entire 100 crore was not eligible for exemption. But this was very wrong. They have corrected that provision and said that no, it will not be like that. Only part of that income will not be subject to what? Will not be subject to income, will not be subject to exemption. Rest of the 98 crore can be eligible for exemption. Okay. So the first violation is what? What is the first thing that the government is stopping you? Do not apply your income for a private religious purpose. Do not apply your income for a particular religious community. Do not apply your income for specified persons. Who's a specified person? Which is mentioned in section 13, subsection 3. But the exemption will be denied only to the extent which is applied for a specified person, not for other incomes. Do not apply your income. Point number 4. Do not invest your funds in any mode other than 11.5. You are not supposed to invest your funds in any mode other than 11.5. You have to invest the fund only in the 11.5 modes. That is what 11.5. What is mentioned in 11.5? I have told you. Mainly government securities. Mainly government securities. So here also the government has removed the word entire and has said that whatever you have invested, only that much income will be considered in total income and not entire income. Okay. So suppose I have 100 crore rupees income and I have invested 5 crore in other than 11.5. What used to happen earlier? Entire 100 crore was used to be taxable. If I am doing a mistake of 5 crore, entire 100 crore has to bear the burden. But now the government has made an amendment. That is the reason I am writing, I am striking off and then I am writing it separately. That you come to know that this is an amendment. But now the government says that we will make violation only, we will deny exemption only to the extent of that investment which is other than 11.5. We will not disallow the entire exemption. Don't worry. Okay. Further, it is clarified that if you invest in the shares of public sector company, it is allowed. Shares of depository, it is allowed, and units of mutual funds, it is allowed. It will not amount to what? Contravention of the provisions of section 13(1)(d). It is allowed, and allowed. Don't worry about it. Okay. It is allowed to invest over there. You are absolutely allowed to invest in that mode. Okay. Now pay absolute attention, please. Have patience. What are the 4 points that we have seen over here? If you apply your income for a private religious purpose, then you are gone. Your exemption will be denied. If you apply your income for a particular religious community, you are gone. Your exemption will be denied. If you apply your income for certain specified person, then whatever amount you will apply, only that much exemption will go. Rest of the exemption you will be getting. And if you invest your money in other than the government securities which are mentioned by the law, only that much exemption will go. Rest of the exemption will be allowed to you. Okay. And if you invest in the public sector company shares, it is allowed. Shares of depository allowed. Units of mutual fund allowed. Now, I have certain issues with this particular provision, which the government has long back clarified also. Now, the issue which I have in front of me, what is that issue? Pay attention. Suppose there is an hospital. Okay, pay attention. It's a very practical question. Suppose there is an hospital. The trustee of the hospital is Mr. A. Or there is a college. The trustee of the college is Mr. B. Now the provision says that the trust cannot give benefits to what? The trustee. Now suppose the trustee is ill and he comes to the hospital. So in that case, the trust cannot treat that particular trustee because the trustee is a specified person. Now it looks very illogical that the hospital's trustee is I. I am the trustee of the hospital and I cannot go to the hospital if I am ill because the provision will be violated. The college trustee is I am, and my son and my daughter cannot go to that college because they are specified persons. This is hopeless. So for hospital and college, obviously think sometime logically. Bombay Hospital's trustee cannot admit their own relatives only in their hospital. For that matter, any other St. Xavier College trustee cannot admit their own children only in their school. It makes no sense. For that purpose, the government has given an exception over here. Exemption not to be denied. Pay attention over here. Exemption not to be denied to charitable trust providing educational or medical circle to specified persons. So if a trust is an educational trust or a medical trust and it is providing benefit to the specified person, exemption will not be denied. However, the value of such facility provided to such specified person, either free or at concessional rate, will be deemed to be income of the trust and such income would not be eligible for exemption. So suppose the trust is a school and the school is giving free admission to what? To the trustee's child, and the value of that in admission is 1 lakh. So this 1 lakh rupees will be subject to what? Will be subject to be income of the trust. And this 1 lakh rupees will not be subject to exemption also under section 11. Okay. It means you cannot apply this 1 lakh and take that as an exemption. Okay. So the what government is saying over here, pay attention please all of you. Again, I am speaking on this point. Suppose there is a trust. This is an hospital. And there is a trustee who is admitted in the hospital. And suppose the hospital is giving the treatment to the trustee at concessional rate or for free. Then in that case, suppose the cost of that free treatment is rupees 1 lakh. Okay. This 1 lakh will be considered to be income of the trust. And the trust cannot claim exemption of this 1 lakh. It means the trust has to pay tax on this 1 lakh. Okay, that's it. Nothing else will be done to the trust. Their exemption will not be denied, don't worry. Their exemption will not be denied under the income tax law. This is what this provision wants to tell you. Just go through here everyone and then we'll go ahead with some very important amendments made by Finance Act 2020. Okay. Now the government is not stopping with this. Now there are some significant amendment made with respect to this point number C. This point number C. We'll just talk about this point number C once again. What is happening in point number C? What exactly point number C wants to tell you? Pay attention please. I'm just trying to make this a very simple thing for you all. Section 13(1)(c). What does it say? That if there is a trust, okay, and there is a specified person over here, who is a specified person who is mentioned in section 13(3), and you are applying the income for them, okay, then the trust will be consequences that the trust has to face. First consequence, there would be denied exemption entirely, proportionately. In the bracket I am writing not entirely. Is there any exception for this? Yes. The exceptions are schools and hospitals. In that case you can apply, but in that case you have to, if you are giving for free or concessional, then that much will be considered as income. Okay. This is something which I have told you. Now I will tell you some more consequences. Suppose the trust has applied the income for the specified person. So the government says that we are not going to spare the specified person also. We will charge that amount as gift under section 56(2)(10). As a gift in the hands of the specified person. We are not going to spare the specified person only. Also, suppose I am a trust, you are a specified person. Who is a specified person? Author is a specified person. Founder is a specified person. Trustee is a specified person. Substantial contributor is a specified person. Any concern in which all these people have invested more than 20% stake or 20% stake is a specified person. So these are the specified person. So if I am a trust, you are a specified person, and if I am giving you some benefit, I am passing some benefit to you, my exemption will be denied proportionately. Say I have incurred 1 crore rupees on you. That 1 crore rupees will not be allowed as exemption to me. At the same time, for you, 1 crore rupees will be gift tax under section 56(2)(10). Check. Amendment made by Finance Act 2022. Check. Both regime. In case of the misutilization of funds for the benefit of the specified persons, the recipient, that is the specified persons, will be taxable under 56(2)(10) in respect of money or property received by him without consideration or for inadequate consideration. Obviously, gift provisions are applicable only if you give without consideration or for inadequate consideration. Obviously, that is something which we have done in 56(2)(10) also. So if you are giving a benefit of 1 crore rupees without consideration or for inadequate consideration, then the gift provisions will be applicable in the hands of the specified person. At the same time, there is one more consequence which they have to bear, the trust has to bear. This is an FA22 amendment. I'll just write it in green. One more FA22 amendment. So if the trust is giving benefits to the specified person, they will be liable for penalties also. So the trust will be liable for penalty. The trust exemption will be denied. The specified person will be liable for income tax if they are getting some benefit without consideration or for inadequate consideration. So the last thing is over here. Sir, how much penalty? How much penalty? Let's see. The new section has been inserted by Finance Act 2022. Let's see the quantum of the penalty, all of you. Let's check the quantum of the penalty, all of us together. Penalty for passing an unreasonable benefit to the trustee or the specified persons. It provides that if it is found during any proceeding under the Act that a person being any trust or institution under regime 1 or regime 2, both the regimes, has violated the provisions of 21st proviso to 1023C or 131C. 21st proviso to 1023C is the corresponding provision of 131C. So for the way for regime 2, it is 131C. For regime 1, it is 21st proviso to 1023C. There is no difference between the two. The AO may direct that such person shall pay by way of penalty. How much? How much penalty? Important provision. How much penalty the government can take from you? Let's see. A sum equal to the aggregate of the amount applied. So whatever is the aggregate of the amount applied by you, by such person for the benefit of any person referred to in 13(3), where the violation is noticed for the first time. So when they are violate, then when the department is observing the violation for the first time, so if they are observing the violation for the first time, then whatever is the amount which is applied by the trust on the specified persons, which you are not allowed to apply, whatever amount you are applied on the specified person, that much will be your what? Penalty. And a sum equal to 20% of the aggregate of the amount of such person directly or indirectly applied by such person for the benefit of any person referred to in where the violation is noticed again in any subsequent previous year. So if the violation is observed for the first time, then the amount applied will become what? Will become the penalty amount. So if the department is observing the violation for the first time and you have applied 1 crore rupees, then you have to pay 1 crore rupees as penalty. In subsequent year, you have to pay 20% of the aggregate amount of income of such person applied on such specified person. Okay. And this penalty will be over and above if there is any other penalty imposed on the assessee. Check here. If there is any other section where the penalty might be imposed on the assessee, that will also be imposed, and this will also be imposed on the assessee. This is the Draculian and the dangerous provisions of the income tax law. There are significant amendments, as I have told you, made by Finance Act 2022. Not small amendments, significant. They have made amendments at every place. Just go through the provision once and then we'll go ahead. Now the government is not stopping here. They have made one more section over here to punish the assessee. The government is becoming harsh and harsh on taxes on trust assessee. They have introduced one more section. Section 115 BBI, which talks about certain special tax rates for trust in certain violations. What is that special tax rate? That to 30% flat without any deductions. Flat 30% tax will be taken on assessees without any deduction in case you fall under 115 BBI, and there are 5 categories in 115 BBI. Please don't fall in this category. Let's see, that is also an amendment made by Finance Act 2022. 115 BBI has been inserted to tax specified income. What do I mean by specified income? Let's see. Of a trust or institution at the rate of 30% plus surcharge if applicable. And obviously cess always. For this purpose, specified income means what? There are 5 categories which the government has made, and if you fall in this 5 category, flat 30% tax without any deduction. Check. No deduction of any expense, allowance, set off of loss shall be allowed. No deduction. Now, which are these 5 cases? Let's see. First case. First case is something which we are doing right now. Misutilization of funds for the benefit of the specified person. So if you are misutilizing the funds for the benefits of the specified person, what are the consequences? Let me make you count. First of all, you will deny the exemption. Second, you will pay 30% tax on that. Third, you will pay penalty on that. Fourth, the specified persons also have to pay tax on that. The relevant provision is given on the right hand side. Any income which is deemed to be income under the 21st proviso in regime 1 and in regime 2, this column is not much relevant for us. For me, the relevant column is the left one. Any income which is not exempt by virtue of 13(1)(c), because the specified person clause is covered in 13(1)(c). Okay, so the first one is misutilization of funds for your specified person. You have to pay 30% tax on that, flat. Second, investment in non-specified modes, that is other than 11(5). If you invest in other than 11(5), 30% flat tax. Any income which is not exempt under this blah blah blah. Any income which is not exempt by virtue of 13(1)(d). Do you remember that? 11(5) was mentioned in 13(1)(d). Do you remember that? The fourth clause was talking about what? 11(5) modes. So if you are investing in violation of 11(5), flat 30% tax. Default pertaining to accumulation of income. You remember that? That if you accumulate the income for 5 years, then you have to apply that income till 5th year. Otherwise, it becomes deemed income of the 5th year. There is also an amendment over here. Earlier, it used to become deemed income of 6th year. Now, it will become deemed income of 5th year. And that deemed income will also be subject to how much tax? 30% tax. So we will just make sure that we'll write down everywhere where it is 30% tax. In this case, it is 30% tax. 115 BBI is applicable. In this case, 13(1)(c) also 30% tax. 115 BBI is applicable. And what's next? Next is this one, 11(3). This entire deemed income, 11(3). 115 BBI is applicable. 30% tax. So these are the cases in which the government is taking 30% tax. Which is the next one? Income applying outside India. If you apply income outside India, now this is only applicable to regime 2, not applicable to regime 1. Not for what? Regime 1. Just write down this over here. So the very objective of making a trust in India is to give benefits of outside India. No, obviously not. You should apply in India. If you are applying outside India, it doesn't make sense. We are not here to give the benefits to the people of Burma or people of Sri Lanka or people of Pakistan or people of Afghanistan or people of other country. We are here to make trust to give benefit to our people of India. Then only this benefit is having some sense. Otherwise, it does not make any sense only. Okay, it does not make any sense. It will become a senseless provision otherwise. Okay, so just check it once. Now, category E. Category E, accumulation in excess of 15%. If you are accumulating in excess of 15%, you have to apply that money. If you are not applying that money, flat 30% tax will be imposed. Income accumulated or set apart in excess of 15% of the income, where such accumulation is not allowed under a specific provision of the Act, you have to pay flat 30% tax on that. So 15% to exemption you get. Rest of the amount you have to apply now. If you are not applying, pay flat 30% tax. All these Draculian provisions are brought by Finance Act 2022. Okay. So this is what this provision is all about. So if you, again I am saying, if you give, misutilize your fund for specified person, flat 30% tax plus penalty also. If you invest in non-specified modes other than 11.5, flat 30% tax. If you accumulate and do not use the money as per the required law and within the time limit of 5 years, 30% tax. If you apply outside India, 30% tax. If you do not apply in excess of 15%, 30% tax. Okay. This is what this provision is all about. Okay. Now there is one small provision over here. Let me go through that provision and then again one more Finance Act 2022 amendment. I'll be speaking about that. So there are a lot of amendments made by Finance Act 2022 with respect to trust. So this topic becomes one of the most important topic for your exams. Be very careful about it. There is one small provision. I'll address that first and then we'll move on to one more amendment, and that is a very simple one, nothing great as such. So this amendment is very simple, nothing great. Okay. The next one, section 13.8, I'll address that. Okay. Now 13.8 has roots with the provision which we have done at the beginning of this chapter. You remember in the definition of charitable purpose, there was one 7th clause which was any other object. You remember that? Which was any other object of general public utility. Do you remember that or not? In that, when can we consider ourselves as a charitable purpose? When your commercial receipt is less than equal to 20% of total receipts. So your commercial receipt should not exceed 20% of total receipts. Okay, now suppose this is the first year. This is first year, say this is previous year 22-23. My commercial receipt is say 18% of my total receipt. Am I eligible for exemption? The answer is yes. So suppose this is my second year 23-24. My commercial receipt is say 19% of total receipts. Am I eligible for exemption? The answer is yes. Suppose this is my third year 24-25. My commercial receipt is 23% now of total receipt. Now am I eligible for exemption? No. Now the question over here is, I am not eligible for exemption, that is for sure, but will my registration be denied? Will my registration also be cancelled? Because of this reason. Because my commercial receipt is exceeding 20% of my total receipt, will my registration also be cancelled? So for that purpose, the government has brought section 13.8 to give you clarification that if your commercial receipt exceeds 20%, your exemption will be denied, no doubt. But your registration will not be cancelled. Don't worry about the cancellation of registration. We will not cancel your registration. Don't worry about it. Okay. So this is what it is written over here. You can check. This provides that if a trust has object of any other object of general public utility and trust has been granted registration under 12AA, now under 12AB, and if the commercial receipts of the trust goes beyond 20% of the total receipts, then the exemption will be denied. Definitely exemptions will be denied to the assessee, but the CIT will not cancel the registration. Don't worry. Don't worry. CIT will not cancel the registration. He will not cancel the registration. So this is what this small provision is all about. You can check this example also on the board which I have written. Okay. Now let's go ahead with the next one. There is one more Finance Act 2022 amendment, which is again a clarificatory amendment in nature. Pay attention, please. Now, to claim exemption, trust has to comply with lot of conditions. Now suppose if trust violates some of the conditions, like some of the small conditions, not very big conditions, like the commercial receipt is exceeding 20% of total receipts. some small violations, like they are not doing audit, like they are not filing our ITR. These are the three small violations they are doing. Suppose the trust is doing these three small violations, then what will happen? So there was a lot of doubt in the mind of the industry that in such cases, what will happen with the trust? Should we charge the entire income of the trust without giving any deductions, or we should give some deductions to them? How to compute the income of such trust who are making some small violations like this? First small violation, the commercial receipt is exceeding 20% of total receipt. Second is not doing audit, not filing ITR. Should we charge the entire income flat without giving any deductions, or we should give them deduction? If yes, which deduction should be allowed, which should not be allowed, what disallowance should be made? In short, in these cases, manner of computation of missing. Manner of computation is what is missing. So to fill this gap, Finance Act 2022 has brought a complete manner over here. Okay. So let's read. First, try to understand the objective of every section. Otherwise, you will not appreciate what amendment is. On page number 54.13, all of you come to this page. Income computation in case of non-compliance. There are various conditions prescribed for availing exemptions under regime 1 as well as regime 2. However, there is no clear-cut guidelines for computation. There are no clear-cut guidelines for computation in case of non-compliance. Non-compliance, a few cases, different provisions mandate denial of exemption to the trust or institution under both regimes. Some of the provisions under which exemption is not available for its violation are as follows. There are three violations they have mentioned over here. Having commercial receipts in excess of 20%, not getting the books of accounts audited, not filing the ITR. Okay. Now, in case of non-availability of exemption in these cases, that is these three cases, there is presently lack of clarity on computation of taxable income. How to compute taxable income? Whether any deduction will be given or whether entire income will be taxable. There is lack of clarity. That's what I have said you over here, that in these three cases, the manner of computation is missing. There is a lack of clarity in computation mechanism of these three cases. So the government has brought this provision. Pay attention, please. This provision is applicable for both the regimes. Don't worry. This is applicable to regime 2 and even to regime 1 also the same provision is applicable. That's the reason I am not repeating that again. When an exemption is denied to trust or institution in any of the three cases given above, which three cases I have told you, income chargeable to tax shall be computed after allowing the deduction for the expenditure other than capital expenditure. First of all, you will not get capital expenditure. CapEx not allowed. CapEx not allowed. Only revenue expenditure allowed. Okay. For that too, you have to incur in India for the objects of the trust subject to the following conditions. So the first thing which we came to know over here, we are getting some clarity now. CapEx not allowed. Okay, fine. At least we have got some clarity over here that government is at least not allowing the CapEx. Okay. Now, subject to some more conditions which they are saying. Subject to the following conditions. Which are the following conditions? Let's see. Such expenditure is not from the corpus. It is not from the corpus. So you should not incur any expenditure from the corpus. If you have some corpus, somebody has given you a corpus donation, you should not incur expenditure from there. It will not be allowed. Okay. Thus, expenditure is not from any loan or borrowing. Incur from pocket, incur from pocket, not from loan and borrowing. Check. If somebody has given you corpus donation, do not use that money to incur expenditure. If you are using corpus donation to incur the expenditure, we will not allow you, because anyways corpus donation is exempt. If you incur an expenditure out of the corpus donation, we will not allow. If you incur the expenditure after loan or out of loan and borrowing, we will not allow. We will not allow claim of depreciation in respect of an asset. We will not allow depreciation when the acquisition of asset is considered as an application. So you bought a plant and machinery of 1 crore and you took that entire plant and machinery as application. So now you cannot ask for the depreciation of that plant and machinery because you have already taken the entire plant and machinery as what? As an application of your income. Check it. And fourth and the last point, such expenditure is not in the form of any what? Contribution or donation to any person. If you are giving donation to any person, don't ask for deduction. So the four things they are mentioning over here, you will not be allowed to do that. First, five things in fact. First is capex not allowed. You cannot incur expenditure from corpus donation. You cannot incur expenditure from what? From loans and borrowings. You cannot take depreciation if you have already taken the application of asset as a deduction. You cannot take a deduction by giving donation to any person. Okay. Apart from that, the disallowances of 40A 1A and 40A 3 and 3A, which is generally applicable to trust, will be applicable to them also who are violating these conditions. So who are violating these three conditions, for them, this is the special mechanism of computation. So 40A 1A and 40A 3 or 3A will be applicable for them. Okay. Sir, will they get any other expenditure or allowance or set off of loss? No. Whatever we have learned over here, only that much will be allowed to them. Nothing else. No 15% exemption, no benefit of accumulation, no benefit of non-receipt, etc. So that you can take the benefit today. All those benefits will not be available to them under any circumstance. It will not be available to them under any circumstance. Okay. I hope it is clear to all of you. Okay. Now, I'm going ahead to the last part of the chapter of regime 2. After that, I have to speak few things about regime 1. And regime 1, there is nothing great in that. Okay. There is something which is very, very straightforward. So for regime 2 is the most important part. The majority of the topic is from the perspective of regime 2 only charitable trust. We are not interested in the institutions which are registered in 1023C and all. That is not very important for example. Sometimes they might ask for 1 or 2 marks. Maximum question they are going to ask for regime 2 only. So let's talk about anonymous donation now. Anonymous donation. What has to be done with that? Anonymous donation is taxable under section 115 BBC. Pay attention please. Shall we start? Anonymous donation is mentioned in section 115 BBC. And what does it say? First of all, what do you mean by the term anonymous donation? Anonymous donation means a donation for which you don't know the identity of the donor. The donor has given the donation without his identity. Maybe a donation which comes in the donation box can be called as an anonymous donation. Okay. Definitely a donation which comes in the donation box will be called as an anonymous donation. That is always an anonymous donation because nobody knows who has put that money in the box. So how it is taxable? Let me talk about it. Suppose you receive a total donation. Total donation of how much? Say 100 crore. Now, in that there are two parts. 10 crore anonymous donation and 90 crore other donation. Now the question is how this 10 lakhs will be taxable? Or at what rate? Will we get any exemption out of this 10 lakhs or not? So the government is very clear. Government says that, listen, write down anonymous donation, 10 crore. Okay. Now we will give you only one exemption. Only one exemption is available from it, which is exemption under 115 BBC. How much exemption? That is 5% of total donation or rupees 1 lakh, whichever is higher. That much we will allow you the donation as a deduction. Don't ask for any deduction apart from that. Okay. So whichever is higher will be considered as your exemption. That is the only exemption. Only, no other exemption will be allowed to you. Only exemption. So how much will come? 5% of total donation or 1 lakh, whichever is higher. Which will come higher? 5% of total donation will come higher. 5 crore you reduce and balance 5 crore will be taxable. At what? At 30% plus surcharge and cess if applicable. Cess is always applicable. surcharge that depends upon the total income of the assessee. Okay. Now pay absolute attention. Sir, will we not get any other benefit? No. Sir, what if we apply this 10 crore rupees for the benefits of the objects of the trust? Will we get the benefits under section 11? No. No benefits of section 11 and 12 will be available on anonymous donation. No benefits of section 11 and 12 on anonymous donation. Nothing will be allowed on anonymous donation. Anonymous donation will be directly taxable in the hands of the assessee. Directly. No benefit will be allowed to the assessee. Okay. Okay, sir. So this 5 lakh will be directly taxable. Yes, 30%. No tax benefit out of it. Now the government is saying one more thing. This 5 crore which is getting exempt now, we are not going to leave that. We are not exempting it fully. This 5 crore should be added to normal income statement. And then you can take 15% exemption and apply the remaining. Then only we are going to give you the benefit for this 5 crore. We are not going to leave this 5 crore also. This 5 crore will also be subject to what? Tax. But not flat 30%. We will allow you to add that to the normal income statement. And then you can take 15% relaxation from there. And then after taking 15% relaxation from there, what you can do? You can apply the remaining money and then you can take the benefit. This is one of the way. This is one of the alternative. There is one more alternative which I will be speaking, or which is not relevant maybe for you all. You can follow this alternative. One more alternative I'll just speak right now only. The other alternative which the institute is doing is, they are saying that this 5 crore will not be subject to what? 15%, and will not be subject to what? Application of income also. You will not get 15% benefit of this 5 crore. You will not get 15%. You will not be allowed to apply this income also somewhere. You have to just add it at the end. We will not take 30% tax on that 5 crore, but you add it at the end. You add it at the end. So you have to be very careful. There are two treatments that the government is giving. I am just changing some numbers. Suppose my total donation is how much? Is 50 crore. And my anonymous donation is 20 crore. And my other donation is 30 crore. Okay. Now, how to determine taxable anonymous donation? First, write anonymous donation. Then take only exemption. 5% of total donation, which will come to how much? What is 5% of 50 crore? What is 5% of 50 crore? 2.5 crore. Then this will come to 17.5 crore. Okay. It's 2.5 crore only now. Now this 17.5 crore is definitely taxable at 30%. But this 2.5 crore has two alternatives which institute is doing. In alternative one, what they are doing? They are adding 2.5 crore to the income statement. Then they are taking 15% exemption. And then remaining amount is applied. You can claim as an application if you have applied the money. Second alternative is a strict alternative which institute is doing. What they are saying? They are saying add to income statement after 15% and do not take any deduction. Okay. You can just take a photograph of this, of the two alternative which institute has been doing in their solution. Okay. Take a photograph of this. Okay. Now, the department is saying that this provision is not applicable to certain assessees. Now, to whom it is not applicable? It is not applicable if your trust is a wholly religious trust. Check. So, Mandir, Masjid, all of them are exempted from anonymous donation. Otherwise, for them, maximum donation is anonymous because maximum donation come in their donation box. So, if the maximum donation is anonymous to Mandir, Masjid, etc., and if you start to take taxes from them, they will kill you. Who will kill you? Mandir, Masjid people will kill you. The government cannot take risk with respect to religion in India because entire politics revolve around what? Religion only in our country. They cannot hurt any religion sentiment. People will start to raise a question. Bhagwan ko bhi nahi choda. They are not sparing gods also. So if you are a completely religious trust, then this provision is not applicable. What do I mean by not applicable? It means you are not exempted. Not applicable means what? Not applicable means it will be, the donation will be treated like a normal donation. It will not be treated like what? Anonymous donation. Not applicable does not mean that we are sparing you and we are exempting you fully. No, no. It means the donation will be treated like a normal donation. Okay. Now, so it is not applicable to a trust which is completely religious. Sir, what about if the trust is wholly charitable? Then it is applicable. If the trust is completely charitable in nature, then it is definitely applicable to the trust. There is no second thought about it. Sir, what if the trust is partly charitable and partly religious? Then what to do? If the trust is partly religious and partly charitable, then what to do? Then the trust has to maintain two donation box. Donation box 1, this will not be subject to 115 BBC. Donation box 2, this will be subject to 115 BBC. It is as simple as that. Okay. Check this. Check this, check this, check this. School, temple, both. School will be charitable, temple will be religious. For school, 115 BBC will be applicable. For temple, 115 BBC will not be applicable because it is charitable purpose. Okay. Okay. I hope it is clear to all of you. Is it clear? Is it clear? I hope it is clear to all of you. Okay. Just go through it once, then we'll go ahead. It's very important provision, please. So you have to just segregate the entire donation into two parts. Anonymous, other. And whatever exemption you are getting over here, there are two alternatives for that. The government has given that. That I have made you right. Okay. That is not completely exempt. One alternative, add to income statement, take 15% exempt, not treat it like normal voluntary donation. Second alternative, add to income statement after 15%. Don't take any exemption. Okay. Just go through it and then we'll go ahead with the next part. Now there is one question in the textbook which is must do question before exam. You have to do this question. You cannot ignore this question under any circumstance before exam. If you are ignoring this question, you are doing a suicidal attempt before exam. You are not supposed to do this. So come to your textbook number 3 in your textbook page number 51.19 in your textbook page number 51.19. There is one question over here. Let's read this question together and we'll do it together only. We will do it together only. Take your calculators in your hand. Take your mobile phones in your hand. To whichever device you are going to calculate the things. Okay. Let's read. Money Foundation, a charitable trust, registered under page number 51.19 in your textbook. Money Foundation, a charitable trust. Registered under 12AB of the Income Tax Act, runs schools for primary and secondary education. The following particulars pertaining to the previous year 23-24 are furnished to you by the trust. Now, the first thing which the trust is receiving is gross receipt from students towards tuition fee, developmental fee and laboratory fee 200 lakhs. Okay. to take this in your calculator, 200 lakhs. Okay. The second thing which the trust is taking is voluntary contribution received from public, including anonymous donation of 5 lakhs. So remove anonymous donation. For anonymous donation, we'll do a different treatment. Okay. So just take the normal donation of 20 lakhs in your calculator. Anonymous donation we'll see at the end. Okay. But otherwise, normal donation is anyways taxable, right? Then take government grant. You are getting some grant from government. Take 8 lakh rupees over there. The total is 228 lakhs so far. Okay. Now you have to wait. Let's see the treatment of anonymous donation. How much is anonymous donation? 5 lakh. What happens with anonymous donation? Of this 5 lakhs, you will get only one exemption. Only one. Which is that one exemption? 5% of total donation. And total donation is 25 lakhs. In total donation, you do not take the government grant. Please, you can take government grant also, then it will become 33. ICI is taking both the answers. While taking the total donation, you can take 33 also, you can take 25 also. We are taking 25. Institute in this question has taken only 25. So 5% of total donation. That is come to exemption. This much will be exempt. So 5% of 25 will come to how much? 1.25 lakhs. Okay. It means 3.75 lakhs will be taxable at 30%. Okay. And this 1.75 lakh, what will you do? This you will add to the normal income statement. So add to the normal income statement 1.25 lakhs. Okay. So how much will come so far? 200. This 20, this 220 plus this 228 plus 1.25 this. So it comes to 229.25. Did you get this answer? 20 lakh this, 8 lakh government grant, 20 lakh this, and 1,25,000 is your what? Anonymous donation, which is getting exempt. You will add to the normal income statement. This is the alternative one. There is one more alternative in which you can add this after the statement, after 15%. That is also possible. That also I will show you. Don't worry. Now after this, there is no other income. Then there is only expenditures. So you will take first 15% exemption. Okay. So you get 1,94,86,250. Okay. So now let's go ahead. Donation given towards voluntary contribution. So voluntary donation is allowed as deduction or not? Yes, it is allowed. Corpus donation is not allowed as deduction. So you will take 2 lakh exemption over here. Okay. I'll just highlight which all points we have done. Okay. Amount applied for the purpose of the school, 90 lakhs. Included in point number 5 above, a sum of 5 lakh being applied for the benefit of the founder of the trust. So first of all, if you are applying the money for the purpose of the school, listen carefully now. 90 lakhs, out of which 5 lakh is applied for the benefit of the founder of the trust. So you will get only deduction of what? 85 lakhs first of all, because if you are applying for the benefit of the founder of the trust, then that is not allowed as an exemption. Yes or no? I have shown you this. I'll show you again. Your memory is very weak. Exemption not denied to charitable trust. Okay. Can you see this? Now, this is the most important point over here. Here you will get confused later on after a few months when you will read the subject at your end. So this 90 lakhs, only 85 lakhs will be allowed as deduction. And this 5 lakh rupees, though, benefit which you are giving to your members, special benefit which you are giving to your members, right? To specified person, that will be considered as deemed income in your hand. You have to add that as a deemed income. This 5 lakh rupees. Did you understand that? First of all, this 5 lakh will not be allowed as an exemption. If you are applying 5 lakh rupees for the benefits of specified person, that will not be allowed as an exemption. But in case of school and colleges, if you apply that money, that 5 lakh should be considered as what? As a deemed income. That is what it is written over here. Check. The value of such facility, either free or concessional, would be deemed to be income of the trust. Such income would not be eligible for exemption under 11 also. You will not get exemption also, and you have to add to the income statement also. Is it clear? Is it clear? So you have to give two effects to this. Don't forget this point. You have to give two effects. Two effects for 5 lakhs. First of all, no deduction of 5 lakhs. And then add to the income statement 5 lakhs. Okay. The trust set apart 55 lakhs for acquiring a building to expand its school. Yes, this you can get. 55 lakhs for expanding the building. You can get that. Okay. Last but not least, the excess of expenditure over income in the previous year 22-23. Will you get the excess of expenditure over income? The answer is no. You can see the first page of this chapter. I have told you, if you incur excess expenditure, then it is not allowed as a deduction under the income tax law. See here, page number 54.2. Do you remember that? Everything is there in the book. So this is a very comprehensive question. After doing all these things, what you will end at the end, you will add what? Anonymous donation, and then anonymous donation will be what? Added, and then this will be your income. Okay. Now this is your first solution. Now let me show you the second solution also. Sir, what is the second solution, sir? Let me show you the second solution. I'll show you the second solution now. Sir, what is the second solution actually? I'll show you. In the second solution, what we are doing is, pay attention please. Now, we are not adding this particular amount here, but we are adding this particular amount at the end. So how the things will change? Let's take. So take this in the calculator, 2 crore 28 lakhs. Okay, now don't add this and take 15% exemption. That will come to 1 crore 93 lakh 80,000. Now then remove all these things. Remove this. Remove 85 lakhs. Remove 55 lakhs. Remove 2 lakhs. Okay. And then add 5 lakhs. Then add 3,75,000 also. Okay. And then add 1,25,000 separately. You will get 61,80,000 rupees in alternative 2 check. In alternative 2, you have to add 1,25,000 anonymous donation at the end, not before 15%. So you will get 61.8 lakh. So this answer is as per alternative 1 and this answer is as per alternative 2. And second doubt which comes to the student's mind, should we take government grant in total donation when we are computing exemption? That depends upon your choice. If you want to take, take. If you don't want to take, don't take. Both is correct. Institute in some solutions they are taking, in some solutions they are not taking. Both are correct as per institute. It's a must do question before exam. You cannot give your exam of CA final direct tax without doing this question. Please do this question. It's absolutely necessary. Okay. Go through it once and then we'll go ahead with the next part. So now let's move on to the last part of this chapter, and that is what? That is the regime 1 now. Now we are actually talking about what is regime 1 actually. Not very important for example. The regime 1 has institutions which are registered under 1023C and they are registered under different clauses. Most of them are nothing but educational institutions and hospitals, and some of them are charitable institutions. And these regimes are not governed by income tax authority. These are governed by central government. So the major difference between the charitable trust and these people are, charitable trusts are governed by income tax law, but these are governed by the central government notification. Let's see one by one, nothing great as such. Let's see the first one. The first one is mentioned in clause 3. The common section is this. Don't forget that this is the common section and these are the clauses. This clause, this clause, this clause, then this clause, this clause, this clause and this clause. Okay. So these are the common sections and the clause are given over here. The first point. Suppose there is a university. Okay. Or there is an educational institution or hospital or medical institution which is substantially financed by the government. So substantially, who is financing them? It is the government who is financing the university. It is the government who is financing the educational institution, hospital or medical institution. Substantially financed by the government. Substantially financed means what? If the government grant to a university or other institution exceeds 50% of the total receipts, then it can be called as what? Substantially financed. So if more than 50% is given by the government, then it can be said that it is substantially financed. So if the university, if the educational institution, if the hospital or if the medical institutions, so more or less who are these people? These are educational institutions and medical institutions. If they are substantially financed by government, their income is exempt under these sections. Completely exempt. Completely exempt. Okay. No need to pay any tax. So where they will file the return? They will file the return under 139(4)(c). They are liable to file the return under 139(4)(c). Be very careful about it, which I have taught you in the chapter of return filing. Okay. Second one is important for us. Pay attention. University, educational institutions, medical institution, hospital, whose annual receipt does not exceed 5 crore. Now, these are not substantially financed by government. These are private institutions. These are not substantially financed by government. So, these are also subject to what exemption, provided their aggregate annual receipt should not exceed what? 5 crore rupees. If their aggregate annual receipt exceed 5 crore rupees, they will be liable for tax. And when we compute the aggregate annual receipt, now you have to compute the aggregate annual receipt from hospital, from medical institution, from everywhere. It means if you have an hospital in your name, plus you have a college in your name, the total aggregate receipt should be what? Less than equal to 5 crore rupees. You have to take from both. You have to take from both. The total aggregate receipts should not exceed 5 crore. Then only we are going to give you exemption. Otherwise, we are not going to give you any kind of exemptions over here. So this, what is the difference between this one and the previous one? The previous one was substantially financed. Here also there are colleges, universities, medical institutions, hospitals, same only. But these are not substantially financed by government. Okay. So if the government is substantially financed, then there is no limit of what? No limit of aggregate receipt. There is no limit of aggregate receipt. But if the government is not substantially financing, then there is a limit of aggregate receipt. Okay. Which should not exceed how much? 5 crore rupees. Now there are certain other institutions. Now these are all doing same activity but under different sections, different clauses. So the conditions might be slightly different in different clause. Suppose the conditions over here are slightly different as compared to the conditions which are mentioned over here. So every clause has its own terms and conditions, but more or less the activities are similar only. Universities, now there are 4 clauses over here. 1023C, clause 4, clause 5, clause 6 and clause 6A. Let's talk about all of them. What is clause 4 talking about? Any other fund or institution for charitable purpose. Now this is for what? This is not for educational purpose. This is for charitable purpose, approved by prescribed authority, having regard to the objects of the fund and or institution and its importance throughout India or through any state or states. So this is for charitable purpose. Okay. So this is for charitable purpose. Now next one. This is for religious purpose, for public religious or only for public religious and charitable purpose. So this is for religious or charitable and religious purpose. This is for what? Solely for education purpose. Any other university or educational institution solely for educational purpose, not for profit. There should not be any profit element, and which are approved by prescribed authority. And this is any other hospital and etc. which is approved under this clause. So these are different kind of institutions which are covered under different clause. Now obviously to understand them in a better manner, you need to see the relevant notification which is issued by the central government for them, which is not a part of income tax law. I am really sorry for that. That is definitely not a part of what? Income tax law. So what is a part of income tax law? You need to see the category of the assessees. First is a charitable assessee who is registered under this clause. Religious and charitable assessee who is registered under this clause. Third is solely for education, registered under this clause. And fourth is hospital, which is registered under this clause. This is what this provision has to say. Just check it once and then we'll go ahead. Now there are some 2-3 small Finance Act 2022 amendments which are there. Let me address you one by one. The first one, first of all, this is a very funny amendment. How it's a funny amendment? Let me tell you how it's funny. Now for both regimes, there is a clause which says that for both regime, that is for 1023C also and for 12AB also, there is a clause which says that if the total income is exceeding the basic exemption limit, then they have to get their accounts accounts what? Audited. Just try to identify such kind of silly mistakes are there under the income tax law. If the total income is exceeding the basic exemption limit, they are supposed to get the accounts audited under the income tax law. Now the question is, unfortunately, there is no provision for maintenance of books of accounts. If the total income exceeds the basic exemption limit, they are liable for audit. What about books of accounts? For books of accounts, the law is silent. Now, how a person can get the accounts audited without maintaining books? It's absolutely impossible. For that purpose, the government brought this provision and said that, we are sorry, that was a mistake in the law. So now, if the total income is exceeding the basic exemption limit, the trust has to get the accounts audited, obviously, but along with that, the trust has to maintain the books of accounts also as per the income tax law. This is what this provision is all about. Let me read it with you all. Where the total income of any trust or institution under regime 2 or under regime 1 exceeds the maximum amount which is not chargeable to tax, that is the basic exemption limit, in any previous year, it is required to get its accounts audited. What about maintaining books of accounts? That is silent. There is no specific provision under the Act pertaining to maintenance of books of accounts by trust or institution under regime 1 or regime 2. In order to ensure proper implementation of both exemption regimes, 12A and 10 proviso of 1023C have been amended to provide that where the total income of the trust or institution under both regime exceeds the maximum amount which is not chargeable to tax, such trust or institution shall what? Shall keep and maintain books of accounts and other documents in such form and manner at such place as may be prescribed. So, moral of the story, along with audit, please maintain books of accounts also. Without that, I cannot do audit. Is it clear? I hope it is clear too. Such kind of small amendments are also there. So the government has taken a pledge that we will amend all the provision in this year only. That by 2023 students have to suffer that particular pain. Nevertheless, try to suffer that pain. Now the next amendment can be an important amendment and which is for only religious places. Okay, some relaxation to religious place. Now, what is that relaxation to the religious place that we have to give? Pay attention, please, all of you. What is that relaxation? Suppose there is a temple or mosque or gurudwara, etc. And there is a donor over here. And the donor is giving voluntary donation. For what? Repairs and renovation. Now, we know that this voluntary donation will be taxable, right? So, the government is giving the temple, mosque, gurudwara an option. Option to treat voluntary donation as corpus donation, subject to some conditions. And if they treat that voluntary donation as a corpus donation, then they will get exemptions under the income tax law. Yes or no? Because corpus donation gets exempt if you invest in what? In the mode specified in 11.5, right? So what are the conditions that the temple or any other religious place has to fulfill? Okay. So let's see. Again, I am speaking that, again I am saying that what exactly this provision is all about. There is a religious place, okay, and this religious place is receiving some voluntary donation for repairs and renovation, which they regularly receive. Now, the government is giving them an option to treat it as what? Even though it is voluntary, treat it as corpus. It's an option, it's not mandatory, but subject to some conditions. Now, what are the conditions? Let's see. Let's come to the next page. Voluntary contribution for renovation or repair of temples. In order to provide clarity pertaining to tax treatment of donations received for renovation or repair of temple, mosque, gurudwara, church, etc., the following amendments have been made with effect from AY 21-22. And in both the regimes, this amendment is made. This amendment is made in regime 2 also and regime 1 also. Okay. So regime 2 I am speaking, regime 1 is same only. Explanation 3a has been inserted in section 11.1. It is applicable as follows. First condition. The property held under trust is a temple or a mosque or a gurudwara or a church or any other notified place. So the first condition tells you that it has to be a religious place. Then only you are going to get the benefit. Second, the trust has received a voluntary contribution. And the religious place has received a voluntary contribution for the purpose of what? Renovation or repair. Put it in the box. It should not be received for some other purpose. So if you are receiving the voluntary contribution for renovation and repair, then only this benefit will be available. The trust or institution circle may at its option treat such contribution as forming part of the corpus. So this is the biggest benefit over here. You can treat it as corpus. Okay. Subject to following conditions. So a voluntary donation for repair and renovation by a religious place can be treated as corpus. So the conditions are, you should be religious place, you should receive a voluntary donation, it should be for repair and renovation, and you have an option to treat it as corpus. Subject to following condition. First, the trust will apply such corpus only for the purpose of for which the voluntary contribution is made, that is for what? Repair and renovation. You will not use it for any other purpose. Second, the trust does not apply such corpus for making or contribution or donation to another person. You cannot give that money as donation to any other person. Okay. You cannot give that money as what? Donation to any other person. Third, it maintains such corpus as separately identifiable. So you have to maintain separate record for that. What is the first condition you are supposed to fulfill? First condition, you should apply that money for repair and renovation also. You cannot give that money as donation to anybody. It should be separately identified and you have to invest that in 11.5. You have to invest that in 11.5 mode, then only you will get the benefit. If you do not invest in 11.5 mode, then you will not get the benefit. If you violate any of the condition, then such sum shall be deemed to be income of the trust during which the violation takes place. And it will be treated like a normal donation then. And you have to pay tax on that. Okay. Now this similar regime is also there in what? Regime 1. The similar provision is also there for regime 1. So regime 1 and regime 2, both of them have the similar provision. Okay. So what is the objective of this? The objective of this section is to give relaxation to religious places, whereby they frequently receive what? Money for renovation. Yeah. Let's not tax that. If they receive the money and use it for renovation, let's treat it as a corpus and give them the benefit of exemption. Okay. So this is what this amendment is all about. It can come in the exam. This is a topic which is highly amended throughout the chapter. Yeah. You can see at every place there is some or the other amendment. Now one last thing is there. Let me speak about that also first and then I'll read. That is also a Finance Act 2022 amendment. Now what is that last thing? Pay attention please. Under regime 2, that is the charitable trust, 12AB. Do you know there is a condition that if you want exemption, you should be able to remember that. Under section 11, then you have to file ROI within time. You know that? If you don't file the ROI on time, then the exemption will be denied. There is a provision for that. But this provision is missing. Missing in what? Regime 1. And regime 1 means what? 1023C. I have told you at the beginning of the chapter that they are trying to make both the regime what? Consistent with each other. So this provision is missing in regime 1. And because this provision is missing in regime 1, so this provision is now also inserted in regime 1. Now even in regime 2, if you want the exemption, you have to file the return on time. If you file a late return, you will not get the exemption. And this is what this last amendment is all about. You can just read it at your end. And then we'll end the lecture here. This completes your taxation of trust completely. Okay. I hope you all have enjoyed the topic. It's a very beautiful topic. There are so many amendments, but we have tried to manage all of them very good. I think so. We have done it nicely. You open the institute's material, na, ICI supplementary, you'll go mad. You'll go mad what they are trying to say. Not be able to understand over there. You will not be able to concise only the things. Okay.